Yeah, situation, so, which sounds like fun, but yeah.
Yeah. Hey, you've done a lot of great, sir. So thank you.
All right. Good morning. Welcome to the second day of our conference. Good morning to all those of you who have found their way through the small streets of Prague. And although I understand some of you, it took. So on the way here, I was checking out the sound of the recording from yesterday, and the sound was good. I don't like the sound of my wall. available online. So, where are you?
I don't.
Yeah. There you go. Cool. So welcome everybody. I was in the middle of telling that some of you lost their way here. I'm glad that you found it, and hopefully those who are still on their way will find their way soon. But then our video got lost, so I'm glad we are all here now. And we start with a special short session by Julia Alicrante. So please, one of the co-organizers of the conference, Julia, the floor is yours.
Thank you, Peter, and welcome back to everyone. So I'll be very short. So one of the core missions of the observatory is to foster an informed democratic debate. So to make this happen, what we do is that we try to organize events with experts such as yourself, produce research and diffuse research that is already there, but also create new information. Like last year, we had the new database on bank CbCR by my colleague Mona. And today we are launching a new database on voluntary country by country reports that are out there in the nature. And we tried to make a database that is usable by research. And we hope it's going to open ways to further version of the database going forward, and with the public country by country reporting being enforced, and with more and more companies disclosing their CbCRs. So I leave the floor to Francisco and then to Kaim, who will present the database more in detail. Thank you.
Hi, everyone. I'm going to keep this very short and hopefully sweet. So we've been collecting voluntarily released country-by-country data from the companies that put this out, and we are collecting the data on third-party and related and total revenues, on the profits of the companies, tax paid and tax accrued, the employees and tangible assets, and then the accumulated earnings and the stated capital. So the same variables that the OECD standard has. And just as a very quick overview of the database, we have now over 4,000 jurisdiction level observations. They come from over 110 multinational companies and over 190 reports. So this means that for about half of the companies, we have data on multiple years. And there are two important caveats for this database, is that not all of these reports have complete data. So we gather whatever we can get. So even if it's 2 or 3 variables that have, we collect them into the database. And another one is that the countries do not the companies do not exhaustively list the countries all the time. So usually it's the case that countries with minimal activity get aggregated into the other segment, but this is not always the case. For example, for BP in 2019, they report data for over 80 jurisdictions, but they aggregate together the Middle East, and in the Middle East, they book profits of 4 billion. So you should bear in mind that this order is sometimes quite big. So on the left-hand side, I know you can see the tables, that's not the point. On the left-hand side, you have how the data is out there in the wild. So this is data that we collected from Inditex. Inditex has 3 different tables in 3 different pages. Each table has data on just one variable. And for 3 years, so 18, 19, and 20. So obviously this data has value, but it's not readily accessible and it's not easy to use as it is. So what we did was we aggregated this data into a format closer to what is usually used by research, or as close as, so in the format on the right, so close to the OECD's standard. In terms of the data that we managed to collect, year after year, the number of reports collected are increasingly systematically. So in 2018, we had less than 20 country-by-country reports. In 2020, over 80. And so this is the case for both the incomplete reports, the ones that we find a couple of variables, and the reports that are very rich on data. And we expect this trend to continue and a lot more reports to be published for the year of 2021, because 2022 hasn't finished yet. So there is this lag. So they should come out anytime now. Just to give you a quick overview of the companies we have, they're mostly headquartered in Europe. So Spain and Italy are the countries with most headquarters. but we have a kind of a global coverage with companies in the US and Canada, Australia and Japan. Many of them are in the mining and extraction sector, but we also have companies in the communications, utilities, and a host of different sectors. And just to give you a quick summary statistics of these companies, so we have companies that are under the thresholds that under the 750 million in revenue a year that voluntarily disclose their country-by-country data, and we also have some of the biggest companies in the world with the revenues in the hundreds of billions of dollars. So the average is quite higher than the median, and our median company operates in 14 jurisdictions with 16,000 employees and about 4 billion in external revenue. That's it for my 5 minutes, but I'll be in the poster session, so I'll be more than happy to answer any questions that you may have. And now Kane will show the app that he has built with this database, which looks very neat. Thank you.
Hello, everybody. As you may have noticed on your badges, there is a mysterious barcode. And actually, if you scan this barcode, it will send you to a web app we have developed to explore this data, which we made using R Shiny for those who are part of the R universe. So I would just really quickly show you this application. It's not really made to be used on your telephone. So if you use it on your telephone, you'll have an idea what it looks like, but it's really best to use it on your computer. Let's see. I don't know if we have the link. Okay, let me give you the link then. Yeah. This one. Okay, CbCR. Here we go. There we go. So here's what this little web app looks like. As you arrive on it, you can take a little tour if you'd like to. So this will show you some of the main elements of what it's composed of. There's also the data we make available on the website. So if you just want to download it yourself and see what's available, then you can just download it right away. Of course, if you have feedback, we are always interested. So the main components of the web app are a page where you can look at the data at the jurisdiction level. So for example, we have 109 companies that are currently in the database. And if you're interested in any specific country, like let's say you are interested in what's happening in the US, you can click on the US, and then if you scroll down, you will have more information on the United States. So you'll have all of the companies we have for the United States and their sector breakdown. So here's the sector breakdown, and then here's all of the companies we have with a couple key variables. I'll go back up. And of course, you can use these different filters here to look at different kinds of variables. Here are the revenues. And there's profit, tax paid, employees. Here's a bunch of filters over here as well. So that's on the jurisdiction level. And then we have a smaller tool for the multinational level. So this is, for example, the same key variables we have. So revenues, profits, tax paid, etc. This is for Shell. So if you're just interested in one company, so you want to look at BP, then you can just look at BP. And again, you'll have BP by country they're reporting in. with their totals here and their top jurisdictions, the top 20 by revenues or whatever variable you choose up here. And then, of course, you have the filters to help you choose, again, companies. So we hope this will be of use to you. This will be updated as we have more and more data coming in. And do not hesitate if you have questions. Francisco will be there during the poster session. So he'll present more of this database during that. So thank you for your time.
The first research session on the effects of CbCR on tax avoidance. So the floor is yours.
Thank you. Thank you very much. Thanks so much to the organizers. This conference has been absolutely amazing. So well organized, right down to the tour last night. Fantastic. I learned a lot of stuff. I verified some of it afterwards. Most of it was accurate. It was fantastic. This paper, I'm Kevin Markle from the Michigan State University, and it's a joint paper with Pratika Joshi and Leslie Robinson. Pratika was cited several times yesterday. So when she was a PhD student, she was like the first mover on CbCR within our little world of accounting. So we're all three accounting researchers. And I think that that's important to tell you because transparency is kind of our jam. Like our colleagues in financial accounting spend a lot of time thinking about transparency and how information is conveyed to people, to the external users. And so when tax comes along, and so the three of us are tax researchers within accounting, but when something comes along in the tax world that says, hey, we're going to really change the information set of the users of these financial statements, then we're like, okay, this is a place that we might be able to contribute. So we're hoping that this is a place that we can contribute. So what do we do in this paper? I've labeled some things new, and I've got to be careful. Like, we're not the first to do any of this, but the first papers in this area, that have hit, have really looked at. There's a paper published in one of our journals, in the Accounting Review, that has essentially shown that after CbCR, when a firm became subject to CbCR, they started to move their real assets, their fixed assets around. So we're not the first ones to do that. But when we looked at the problem, we said, it's not necessarily universal. It's not going to affect everybody the same way. So what I want to highlight bullets 4 and 5. Those are really what we think is our innovation that we're bringing to the literature is, when you think about it, how should they respond is really more a question of where should they respond. And then this last one, bullet number 6, obviously we're not the first ones to think about a macro effect, but we think we're the first ones to go in and show it. And we've come up with this way to kind of look at CbCR exposure and the macro. So hopefully I'll be able to convey what we're doing and get your feedback on what we're doing. So what do we find? We find, I think, what's hard, I guess we find what we predict, but we actually weren't entirely sure what we were predicting. So 2 of our hypotheses are stated in the null because we really didn't know what to expect. But we do expect firms to respond to this. We expect them to do something, either real or to adjust their paper shifting that's going on. And so we do find that in the affiliates who we think were the outbound profit shifters before, we see them adjusting not their profits, but their assets. And I'll show you more as we get there. All right. This came up yesterday in the panels, which was great. I was sitting there smiling ear to ear because what do we expect them to do? Well, the handbook put out by the OECD said, look, a lot of this information is new, right? There's a lot of stuff that people outside did not know. And went so far as to say, taxing authorities, one thing you might want to do is you might want to look at a bunch of financial ratios, things that are coming off the financial statements. Because if you can come up with the appropriate benchmark, then you'd be able to identify abnormal activity, things that are potentially indicators of risk. And I think it was pointed out yesterday, this is not meant to be a source of information to go after and say, hey, we found proof that you're cheating. It's just an assessment of risk. But if you're the firm and you know that this is how the information is likely to be used. So I've just paraphrased. The OECD says, here's how we would like it to be used. But I think that most firms have interpreted that as it's going to give the authority something to flag us to some, hey, there's somewhere to look. Now, we may not have anything to hide, but it's going to give them a place to look. And anytime light is shone somewhere, you take another look at it yourself. So we expect that's what to happen. All right. So misalignment is the way that we're thinking about this. And this came up yesterday too. And again, this is, I don't think it's not new in any way, but it's, I think, important to think about because it really is about, are you earning appropriate profits in a jurisdiction? And you can only define appropriate if you have some sense of, well, what should it be? And so, as I showed you in that handbook, it's really, well, profit and real activity should have some sort of relationship, shouldn't they? Like, shouldn't there be, if you have a certain amount of activity, you should have a certain amount of profit. And of course, there's lots of reasons your profit can deviate from your activity. Like firms very justifiably could say, we're just better at using our assets than everybody else. So our profit is higher there. And of course, that can be absolutely true. But in the big sample, if you look for outliers on these dimensions, so how we're going to measure it is very, very, very straightforward. We're going to come up with a ratio. It's essentially profit on the top and some measure of activity in the denominator. Get that ratio and then come up with the appropriate benchmark. Back in the handbook, I won't bother going back there, but they suggest multiple benchmarks. They suggest you could look within the multinational, you could look within peers outside of the multinational. And so we're going to look at a very broad benchmark. We're going to look at all of the firms in the same country year. There are other benchmarks, obviously. So I want to just make it clear what we're doing. We're using the Orbis data, and this is my wonderful artwork on what we're doing. So we have 10 entities here, and we're going to take all of the unconsolidated. This is not uncommon. The literature has been doing this for a long time. We're going to take if we have a large group within a country, we're going to aggregate those up into one entity. Now, obviously, that is, it's a choice, but we think that that's the closest that the authority is also going to be doing. So again, we're not using the CbCR reports. We're using financial statement data from before CbCR hit and after CbCR hit. The only time we're using the CbCR reports is in the macro stuff that I'm going to show you at the end. So this is all financial statement data. And so when you think about the forms that we've seen multiple times now, it's all aggregated up to the country level. So we think this is the right way to go. And so I don't want to get bogged down in this, but this is just a random sample or a random idea of, I've generated these numbers randomly. For those 10 entities that I showed you on the previous slide, we're just going to take their profits, pre-tax income, and we're going to take their fixed assets or their employees. I'm showing you in fixed assets here. And then everybody gets the same benchmark within that country. Everybody has the same benchmark, the ratio of the aggregate profit and the aggregate fixed assets. And then your individual misalignment is calculated as the difference. Well, sorry, your individual ratio is calculated based on your numbers. And then your misalignment is the difference between those two numbers. And we're taking the absolute value right now, not to get too much into the weeds. We're still trying to figure out whether that's appropriate or not. But for now, we're taking the absolute value. We also are going to use a decile rank in the last column. And the reason that we're doing that, one is it's a little bit less, it deals with the outliers a little bit better. But also we want to be able to come up with some sort of index, some sort of combination of your fixed assets and your employees. And because the ratio of profits to employees is going to be very different from ratio of profits to fixed assets, we need some way to sort of standardize them. Okay, so how do we expect firms to respond? We expect them to, if they are misaligned, we expect them to reduce that. But they could either bring their profits closer to their assets or their assets closer to their profits, or they could do both. And so we're going to look at each of those pieces individually. But this, as I pointed out at the beginning, is where we think our innovation is. Where should they respond? So misalignment, being misaligned, is not unconditionally a problem for the taxing authority. If the taxing authority sees profits and assets are out of whack, they don't automatically think, oh, something is going on that is costing us tax revenues. The only thing that's costing an authority tax revenues is when the profits seem lower than they should be. If the profits are higher than they should be, the authority's like, we're good, stay right where you are, don't change a thing. So we go and we classify the affiliates, like we compare them to their peers, we rank them on profit, and we rank them on fixed assets or employees, and we put them into one of these 9 cells based on their ranking within. So we use quintiles, and top 2 quintiles are high. So it's really only cell 3 where any taxing authority should be upset or should be thinking, wait a minute, we're losing tax revenue here. And then we're going to use cell 9, the bottom, the high, as sort of our benchmark for, they really, nothing should happen there. If you have high activity and high profits, that's sort of okay. That shouldn't be a flag for any kind of taxing, for any taxing authority. All right, so our hypothesis is very straightforward. We want to see if those cell 3 affiliates, if their misalignment changes, and then separately, does the numerator change and does the denominator change? We want to know, are they changing their profit shifting? Are they changing the amount of profits that move, or the amount of assets, or both? So the question is there any reason to think that they wouldn't? And there are lots of reasons, I think, to think that they wouldn't. And so I've listed some of them here. One of them is there's absolutely no one's ever been, as far as we know, they've lost transfer pricing cases, but it's not illegal. What they're doing is not illegal. So it's entirely possible, I believe, that shining this light is actually going to embolden the profit shifters. It's going to say, look, everybody's doing it. Here's the baseline. We're not abnormal. It's also possible that there's groups out there who are like, oh, I didn't know we could shift this much and get away with it, because now we get to see from what everybody else is doing. So I think that's possible. And then, of course, we get a lot of support from the Jane's paper that's going to be presented next, because in the US, we're finding no effect. They didn't change anything of what they did. Sorry, spoiler alert. She's still got lots more to tell us. I do want to point, I added this slide last night. I didn't have this slide. And then after the discussion yesterday, I was like, oh, wait, I got to make sure I highlight this. We're using the Orbis data. And yes, it's flawed, completely flawed. But one of its biggest flaws is the missing information about the destinations for shifted profits, the low zero tax countries. We just don't have the data. Not a problem for us, because we are just looking at high tax countries, the countries that in expectation, nobody should be shifting profits to them in the first place. So we're looking very unidirectionally. So obviously that's not great. We would love to have the data on Bermuda and the Caymans, but since we don't, we think this is actually a place where we have complete data, or more complete data, for what we actually want to do. All right, so let me show you what we find. We do find a strong effect on our misalignment variable. So remember, we're calculating this basically as the difference between the firm's ROA, in this case, the return on assets, and the benchmark ROA within the country year. That drops in our outbound shifter. So these are each column is just a different version of misalignment. And so because we don't know which one is going to be focused on, but you can look at any individual column, and it's kind of reassuring that we get a similar result across different measures of misalignment. Again, as the benchmark, I don't highlight it here, but cell 9 those are the high. They were high activity, high income before CbCR, and so they should not have reacted. We do see some reaction. That could be, as I was saying, that sort of license to match, that sort of, wait a minute, we're not sure if we're far from the line or not. So it could be that we need to get our house in order. We don't know, but it's not universally negative. then what are they doing? Are they changing their profits or are they changing where their fixed assets are? What we find is that they're changing, or their employees. I keep forgetting the employees because our main thing we focus on is the fixed assets. But with the fixed assets, it looks like they are moving their fixed assets. They are moving them out of their high tax countries. Does that make sense? Well, it does make sense because the problem in the high tax countries is that the profits are too low relative to the fixed assets. So this looks like what we would call real shifting is going on. This is also consistent with that other paper I told you about where they said they found them moving fixed assets. Okay, we do not find them changing their profits, meaning they're not actually bringing more profit back and having it taxed in the high tax home country or the place where the misalignment was occurring. All right, this is something that we have just come to. So within the last month, we've added this based on feedback. And so it is somewhat new. And we think, so we're actually still figuring it out. What are we learning here? But I'm going to tell you exactly what we're doing. People suggested, listen, if these are the biggest multinationals in the world, and they're actually changing where they're investing, where they're putting fixed assets, shouldn't that show up in the macro data? We're not macroeconomists. We understand how it all works, but we've tried to tool up and get to the point where we're on what we think are valid tests. We're taking cross-border. So we do it first, just all FDI, but the one I think that is most interesting is this country pair data, where we have the investor country and the investee country. And then we've taken the CbCR reports that have been published. So this is after the fact, and said, can we come up with some way to code a variable that for that country pair is kind of what we're calling it, the CbCR exposure. And all we're doing is saying when a firm files a CbCR, they're going to list a bunch of countries. So for every German multinational, how often does Czech Republic show up? And we're going to scale that by the total number of reports, and that will be the CbCR exposure. So let me just show you. This is what comes out for Germany. Germany is the parent country. We've got lots of variation in the investment that they make into each country each year. And on the right is our measure of the CbCR exposure coming off of the CbCR reports. So we're just going to put the left graph on the left-hand side and the right graph on the right-hand side and see what comes out. We're also, though, very importantly, going to put in a diff and diff and interact it with a statutory rate difference. So this is the part where I told you before, we're only focused on high tax countries. We become a little bit more, we're not consistent with that here. We're including everybody because these data have everybody. And so we need to figure out a way to capture almost like our cell threes. We need a way to capture. This shouldn't show up everywhere. It should only show up when there's a high tax, low tax match. So right now we're just taking the difference of the statutory tax rates, but I think we need to refine that, but I don't know. Anyway, so right now we're doing the statutory tax rate and we're finding that as that difference increases, so as high tax to low tax, the amount, if you're exposed to CbCR, after CbCR, your investment into that country goes down. And I'd love to just say, hey, isn't that great? That's actually inconsistent with what we're finding at the firm level. So at the firm level, we're finding it's coming out of high tax countries and inferring it must be going somewhere else. And we would think maybe to the low tax countries. We don't confirm that. We can't in our data. This seems to say it's not going to the low tax countries. So the only other place it could be going is to another high tax country. And we haven't yet figured out how to get to that. All right, so that's our paper in a nutshell. Am I okay for time? Okay, I have 2 minutes. That's a minute per, I'm kidding. This is great. Just summarize what we're doing. What we're doing is we have our innovation. Let me focus on the innovation, is coming up with some way to figure out where should this matter? This should not be, oh my goodness, we've got to change everything about what we're doing because now people know more about our company. That shouldn't be the case. It should only be the case in the places where the authority has concern. That's high tax, outbound income shifters. We come up with a way to identify those, we hope, that is valid, and then we find that they are reducing their misalignment consistent with expectation, but it's not resulting in any increased tax revenues for those high tax countries. Thank you. Kim.
This is a very interesting paper. Really happy to hear it. I have a question. So when I think as an economist about what's easy and hard to do in response to a change like this, what seems easy is changing something that's reporting. And what seems hard is changing something like plant equipment.
Right.
And so this feels a little bit counterintuitive in the sense that the companies are responding pretty swiftly, right? The time frame isn't that long.
Agreed.
By changing plant equipment. So have you talked to any companies, or do you have any sense of whether this is the reporting of plant equipment or the actual machinery, right? So we could imagine that this is, well, we should look under every sofa cushion for something we could say is here.
Right.
Or we could imagine, well, we're actually building a plant, or we're actually moving a piece of machinery. I think these latter two things are much harder to do swiftly. At least most economists think investment can take, like you have an incentive, it could take up to 8 years for all the planning and all of that. So do you have any like instinct from your conversations with people about what's really happening?
I wish that I could answer that yes, and I don't, but it's a great point. We should have those conversations because, you know, again, we're using the financial statement data through Orbis. It is entirely possible that this is this is a joint project. And up until now, we had put it on the balance sheet of this company. It's simple. Let's just put it on the balance sheet of that company. And really there's no sale. There's nothing because, so that's a great idea. I don't know how we get it in the data, but we could, an anecdote would go a long way. Because you're right. It doesn't seem like it should be able to happen that quickly. If these are actually, you know, buildings or machines, maybe the machines are a little bit easier to think about. You would think employees might even be a lot easier actually than assets. So yeah, I guess it is surprising. Yeah.
I just want to add another with what Ingrid was talking about. I work with FBI. So I'm an FBI guy.
All right, I'm gonna get your card.
And what we see is that these kind of things are clear important discrimination is between tangible and intangible assets. So those fixed assets, that would be really good to understand. If they are tangible, then what we see is that FBI is super sticky. So it's something that does not really move. We have been listening for years about reshoring, for example. It's not happening. It's just not happening. So this investing or moving stock is something that it's really hard because of cost, around incentives, around commitment.
Yeah.
So I would say that two important areas. One is whether this is a practice or it's a real one. The other is whether these country these fixed assets are tangible or intangible.
Okay.
Maybe in the case of intangible assets, it's easier to know this.
Yeah, it's great. And actually, I'm pretty sure in Orbis they have fixed assets and they have tangible fixed assets. I'm pretty sure we're using the first one, and so we could look for some. If it shows up in fixed assets but not tangible fixed assets, that could help us at a very high level. That's really helpful. Thank you.
Also, I was wondering about this. So I understand that it caught many people's eyes. Was thinking, how big is it? So I understand it's statistically significant, but you know, also to see how big problem you have to explain.
Yeah.
You know, maybe it's very small.
Yeah, we have not done that, and we need to. So the economic magnitude on these RDs is tricky. So we haven't done it yet, but we need to. We can't avoid that. So I don't have a way to answer that, to be honest with you. I don't know what it represents in dollar value of assets. Not too happy to put that in front. All right. Thank you very much.
My PowerPoints.
Yep. This one. If you could pull up the PowerPoints instead of the PDF.
Sure.
That would be great, but if it's not, then this is still
I would
fine.
never be able.
So you didn't have such great experience with PowerPoints, actually.
Oh, okay.
But-
If the PowerPoint might not work very well, then we can use the PDF. That's just fine.
Sorry, that's not it. Is that it? Wait, I was looking in the wrong folder. Sorry.
Yeah, it's.
There you go. There we go. Yeah.
Yes, yes, it's great. Let's see. All right. Thank you so much for having me. It is a pleasure to be here. And I just like to thank the organizers for inviting me and giving me this opportunity to present this paper. So Kevin gave you a little preview of my results, but luckily I have more to say. So this is joint work with Michelle Nessa, Ein Pearson, Aaron Towery, and Mary Vernon. And in this paper, we examined the effect of U.S. country-by-country reporting on U.S. multinationals, income shifting and real activities behavior. So as a disclaimer, this project is conducted as part of the IRS Joint Statistical Research Program. So all the views expressed in the paper and presentation are those of the authors and myself and not that of the IRS. Okay. So with that out of the way, I don't think I need to convince this audience that country-by-country reporting is perhaps the most important achievement of the OECD's BEPS initiative. And prior studies that examined the effect of CbCR adoption in cross-country settings, primarily in a European setting, do find evidence that there are behavioral changes. There's evidence of a reduction in tax avoidance and income shifting, an increase in the allocation of real activities in these lower tax jurisdictions, primarily in these other settings. So then why are we revisiting this in the US setting? Well, we know that US multinationals are important, large global players in the world economy. And then also the US implementation of country-by-country reporting is rather unique and the context surrounding that. So knowing whether these findings in other settings translate to the US one is important, and that's a focus of our study. Okay, so in this study, we specifically examine the effect of US CbCR adoption on US multinationals, and we leverage this confidential US tax return data and country-by-country reporting detail. So our research questions are twofold. First, does US CbCR provide the IRS with incremental information about US multinationals' worldwide activities that could be helpful in identifying and combating profit shifting? And we think that with this unique data set of US tax return data allows us to look at this. And then second, did US multinationals actually reduce their income shifting activities or change their allocation of real activities in response to CbCR? Okay. So just to provide a bit of a backdrop, US CbCR is required to be filed for multinational groups with consolidated prior year revenues of at least $850 million or more, starting June 30th, 2016. And like other CbCR adopting countries, for each multinational group, they must report the following activity for each jurisdiction in which they operate. So those are all listed there. But what's unlike many other countries is that the US also did not simultaneously implement some of the other documentation requirements or documentation proposals proposed by Action 13, including the master and local files. And also the US is not a signatory to the OECD's multilateral competent authority agreement, which facilitates the automatic exchange of country-by-country reports among all member jurisdictions and states. Okay, so instead the US negotiates bilateral treaties with individual countries. And so with those details in mind, we turn to our first question, which is whether CbCR provides the IRS with any additional information. And knowing that's important to evaluate whether we think US multinationals might respond to it. Okay, so we do this by comparing the countries that are reported on US CbCR, so these forms 8975, with the countries that are reported on Form 5471, which is an existing US tax filing that already provides extensive information about certain foreign affiliate activities. Okay, so we conduct several descriptive analyses of countries that are on both CbCR and on this existing filing, which we call overlapping countries or overlapping activity. And also we look at countries that are reported on US CbCR, but are not on this existing filing, which we call non-overlapping countries or activity. And that's where we believe the source of any incremental information would be. Okay. So of course, there are many reasons why countries might be reported on CbCR, but not on these filings. And a lot of it boils down to the differences in the filing requirements. So this is just a high level list of the differences. One of the most prominent ones of course, is that CbCR aggregates all the information at a country level, whereas a Form 5471 is filed at an entity level for certain foreign corporations. The information that's reported on both is similar, but not identical. And one key distinction here is that CbCR includes all the consolidated activity of multinational within a country, whereas this Form 5471 only includes the activity of foreign corporations. Okay, so those are some of the key differences. And I just want to note here that just because a country is reported on CbCR but not on this form doesn't necessarily mean that the IRS isn't aware of activities in those countries, because they can still be reported on other filings. It's just that Form 5471 provides arguably the most extensive information that's more analogous to what would be on CbCR. Okay. So when we look at the activity that is reported on US CbCR and compare it to what's reported on 5471 for tax year 2017, we see that there is substantial overlap between the two forms. So what you're looking at here, what's in the gray bars, that's the percentage of all the CbCR filings and activity in those filings that are in countries that are also reported on 5471. So there's a significant amount of overlap, which suggests that US taxing authorities already have a lot of information. But in spite of the high overlap, there still appears to be some incremental information. So some countries that are on the country by country reports, but not on this form. And so we delve deeper into this non-overlapping activity. And so on this chart, we break that non-overlapping activity, what we're considering incremental activity, into activity that pertains to low tax jurisdictions. That's based on the Heinz 2010 list of low tax jurisdictions, and those that are in non-low tax jurisdictions. And what we see is that even though only about 19% of CbCR filings are located or related to low tax jurisdictions, there's a disproportionate amount of activity, particularly related party revenues, pre-tax profits, and accumulated earnings that are in those low tax jurisdictions. And these are the metrics that are most commonly associated with tax motivated income shifting. Okay. And then when we zoom even further to look at the specific countries that, that these profits in particular are attributed to, when we look at the non-overlapping pre-tax profits and the top countries they're located in, we see that a majority of it is in the Cayman Islands. So $39 billion or 46% of the total non-overlapping profits reported on country by country reports are located in the Cayman Islands. So in aggregate, these descriptive statistics suggest that CbC reports are providing some incremental activity or incremental information to US tax authorities. And a lot of this information is related to activities in low tax jurisdictions. But moving away from the aggregates, then we want to look at whether this incremental activity is all information, is associated or indicative of some kind of increased income shifting risk. Okay, and so to do that, we compare these income shifting risk indicators that are proposed by the OECD. So these are the same ones that Kevin brought up in his previous in his presentation from the OECD handbook, to look at these various ratios. So we split the countries into non-overlapping countries and overlapping countries, and we compare these red flags or tax risk indicators. Okay, so if CbCR provided incremental information that's suggestive of increased income shifting risk, then we would expect for the non-overlapping countries, in this case, the red bars, to have higher values of every one of these ratios, except for effective tax rates, relative to the overlapping countries. Okay, but what we see is the opposite. We really don't see that the non-overlapping countries where the incremental information is are really all that indicative of greater income shifting risk than the overlapping countries. So overall, it's unclear whether the information that's provided, the incremental information in US CbCR, is helpful to the IRS in combating profit shifting. Okay, so to summarize, in general, when we compare the existing US filings with CbCR, we find high overlap. So the US taxing authorities already have a lot of information. However, when it comes to the incremental information in CbC reports, we find that a disproportionate amount of that information is on profits and related party revenues and accumulated earnings that are in low tax jurisdictions. So overall, it's still unclear whether this incremental information would be all that helpful to the IRS. So that naturally brings us to our second research question, which is, did US multinationals reduce their income shifting or change their real activities in response to US CbCR? Okay. So as I mentioned earlier, there are a number of prior studies that do find that there's been a reduction in tax avoidance, income shifting, and increase in real activity shifting among multinationals in other countries and other adoption regimes. But there are reasons why US multinationals might respond differently to US CbCR. So as I mentioned, the US already has a very extensive disclosure regime. So whereas many other countries might not have had quite as extensive disclosure requirements, so CbCR likely provided more additional information for these other regimes. And then second, the US adoption was a little bit different, right? So I mentioned that the US didn't implement the master or local file requirements that were proposed by Action 13. So that could have resulted in less information provided to US taxing authorities. And in addition, the US also exchanges fewer country by country reports with foreign tax authorities because they did not, they're not part of the OECD's automatic exchange. So the US exchanges roughly a third or exchanges CbCR reports with roughly a third fewer countries than their OECD counterparts. Okay, so there's less information available to foreign taxing authorities from CbCR. So if US multinationals really don't expect CbCR to enable tax authorities to successfully challenge their income shifting positions, then they may not alter their behavior. Okay, so we examined this by using tax return data and detailed CbCR data from the IRS. We examined the time frame from 2011 to 2018, and our sample consists of 1,933 publicly traded US corporations that file Form 5471. So that's a tax filing that I mentioned earlier, and that's our source of foreign affiliate information. And this allows us obviously to provide a baseline for income shifting behavior prior to CbCR adoption. Okay, so we conduct several analyses using two empirical approaches. Our first approach is to use a differences and differences framework to examine whether US CbCR affected tax motivated income shifting. And so we're adopting the classic Hines and Rice income shifting model that's adapted by Huizinga and Levin. Okay. And in this model, CbCR is one for the treatment multinationals, those that meet the filing requirement. Post is for tax years 2016 to 18. And then the tax incentive variable that we're using is the C variable. It's C5471, as you see here, is the revenue weighted statutory tax rate differential between a particular country that the affiliate is located in and all other countries in which the US multinational group operates. So this is from Huizinga and Levin. And our variable of interest is this three-way interaction on CbCR, the treatment times the post variable times the tax incentive variable. Okay. So if US multinationals reduce their income shifting after CbCR, then we would expect to see a positive beta 1, meaning that that their profits are less sensitive to the tax incentive to report in a country. Okay, so we would expect a positive beta 1. All right, so when we look at the results, I thought it'd be easier just to show this graph, and what this is showing here is an incremental difference in the C variable between treatment and control groups over time. Okay. So if US multinationals decrease their tax motivated income shifting, then what we would expect to see is a positive beta 1, or in other words, that there is a relative increase in the C variable in the post period. Okay. But we don't see that. Instead, what we're observing is no change in the relative tax motivated income shifting between the treatment and control groups, with a beta 1 of negative 0.527. That's insignificant. Okay, so our second approach is to use a regression discontinuity design. Okay. So we leverage that $850 million reporting threshold, and then we partition the sample into countries in which there is a high tax incentive to report profits in those countries. So there would be, these are the countries with the low tax rates, and we partition them into also countries where there's a low tax incentive to report profits in those countries. And what we would expect to see is a stronger discontinuity or reduction in profits reported in countries in which there's a high tax incentive to report profits. So that would be consistent with US multinationals reducing their profit shifting or reducing profits reported in those lower tax countries if they have a high tax incentive to report there relative to countries where there's a low tax incentive to report there. So bottom line is, we really don't see a discontinuity at that threshold. And we don't see a differentially lower discontinuity there relative to the low tax incentive group either. So collectively, through our differences design and the research, or the regression discontinuity design, we don't really find an evidence of a decrease in income shifting after CbCR. Okay. So now we turn our focus to real activity. So our multinationals changing their real activities and moving those into locations where they're reporting excess profits to substantiate those profits. And so this is what Kevin was doing earlier. And so for brevity's sake, I'm just going to present the results. So we're looking at the same thing here. We're graphing the incremental C variable between treatment and control groups over time. Now, in this case, what we would expect to see is a negative beta 1 on the three-way coefficient. In this case, the dependent variable is no longer log profits, is log tangible assets or compensation to capture the movement of real activity. So a negative beta 1 would be consistent with multinationals increasing their real activities in jurisdictions where they have strong tax incentives to report profits. So in other words, shifting real activities into those jurisdictions. Okay, so we would expect a downward trend in the post period. But we actually don't see that. Instead, we have a positive beta 1, which suggests that there's maybe a decrease in the responsiveness of real activities after CbCR. So overall, that's not consistent with movement of real activities to substantiate reported profits. So ultimately, what we're finding is basically either no result or kind of the opposite of what we were expecting if multinationals would have reduced their income shifting. And similarly, when we look at the RD results, so what we were expecting to see if multinationals are increasing their fixed assets in low tax jurisdictions or where they have high tax incentives to locate fixed assets, we would expect to see a positive discontinuity, a more positive discontinuity around the reporting threshold in the high tax incentive group relative to the low tax incentive group. And again, we don't see that. So overall, we don't find any evidence that there's an increase in the responsiveness of real activities to tax incentives to report profits after CbCR. All right, so next we conduct a few cross-sectional tests to delve into why this could be. And I mentioned earlier that there are a number of differences between US implementation and the US setting and other settings. So in a nutshell, where we actually do find a decrease in tax-motivated income shifting is among the subsample of US multinationals where we expect CbCR to provide more incremental information. So they have lower overlap between the existing filing and CbCR. And in addition, in the subsample where there's more information sharing. So these are multinationals that are located in more jurisdictions that have exchange agreements with the US. So this is obviously a lot fewer multinationals in the entire sample, but it is kind of where we would expect the effect to be strongest. So in this subsample, we do see a decrease in tax motivated income shifting. All right, we conduct a series of additional analyses. And to conclude, we provide some of the first insights into the incremental information that's provided by CbCR relative to existing tax disclosures and into the responsiveness of US multinationals. We find that US CbCR does appear to provide some incremental information, particularly about certain activities and low tax jurisdictions. But unlike other studies, we don't find evidence that US multinationals change their tax motivating income shifting behavior. And so all this highlights the importance of considering institutional settings and factors when trying to analyze expected responses, and also suggests that private CbCR disclosure may not be sufficient as a deterrence mechanism for US multinationals. And thank you very much. Yeah, Kim.
So another great paper, really interesting, and so happy to hear it. I have two little questions for you. One is about this master local file decision. I wonder if you have insight as to how important that is. And I'm also kind of curious about how much the IRS is maybe hampered in their ability to use this information in part by other constraints because of their, widely known lack of adequate funding over the prior 5 years. We might not think of like 2017 as the time where they're like the most agile and fleet-footed with respect to using new information. So I wonder if you have thoughts on either of those.
Yeah, well, so to your latter point, I can't speak to the enforcement, but I completely take the point. This is just early data. All we have are the first couple of years. So it's entirely possible that there might be a lag in the effect, especially also as multinationals unwind their positions. So what we're observing is really just in the first few years. As far as the documentation requirements, so currently transfer pricing documentation isn't required to be filed with the IRS. So the master and local files presumably would provide additional information about the multinational's overall structure. We haven't specifically delved into parsing that out just because there's no variation in that yet in the US setting, but that might be something to look at in foreign settings to see, well, which countries adopted country by country report alongside other documentation requirements. But currently, I think multinationals can voluntarily file transfer pricing documentation, but they're not required to. I don't know if that answers your question. Yeah.
Question for you or maybe the room. Was there any other country that didn't do the local master?
There are others.
There are.
Yeah.
Outside
But these are
the EU, like did everybody in the EU have to?
Sure. It's likely there'll be a direct,
maybe
I'm guessing, but
It is interesting.
yeah, a lot of them are maybe not in the EU.
Okay. Because it Kim's question, like it would be interesting to know if that's like the sharing thing, because really a US multinational, I think the US has known a lot about them.
Mhm.
It's the foreign governments that have been really mad for many years and want this information. So it's incremental to the foreign governments, I would think for sure, but not that they're not, are they not getting?
Well, so the foreign governments wouldn't have access to the master and local files. That would just be provided to the local governments, but through the exchange agreements, they would get the CbC reports, and the US just exchanges those with fewer foreign governments and other CbCR adopting countries. So that could be, one expectation that there's less being provided to foreign tax authorities, potentially.
Have you thought about how to going forward, how to tease this out from the guilty, because we kind of really only have 1 year.
No, this is,
Like,
this is
so-
why we stopped.
Right, like
This-
2016, it's voluntary,
boy.
2017, it's a real thing, but even by the end of 2017, companies know the tangible assets start to have its other role, which is QI, right? Like, so
Yeah.
that
Yes.
does make this a really tricky empirical question.
I agree. And, you know, and we were even reluctant in including 2018 because of all the confounding effects of TCJA. So, so it is a problem.
I'm
I agree.
sympathetic.
I don't quite know how we would deal with that. But hopefully, I mean, you know, these other provisions apply to all multinationals, not just over the threshold. So maybe we could leverage the regression discontinuity more in the later periods. All right. Thank you very much.
It's good that you put something.
Right, so good morning. My name is Simon. I'm a PhD from KU Leuven, and I'm very happy to present today this joint work with Miroslav Petter and my supervisors in Belgium, Vita and Christoph, on the effects of CbCR. And we're moving back to Europe after an excellent presentation about the effects in the US, and I'm going to try to paint a slightly different picture of the effects of CbCR in Europe. So basically the main takeaway that I hope to convince you of this morning is that country by country reporting was effective in Europe in increasing effective tax rates for reporting M&Es. Which we see as an increase or an improvement of tax compliance by these multinationals, but these effects are heterogeneous. So the most aggressive multinationals with the most aggressive profit shifting strategies were less affected than less aggressive multinationals. So there's some kind of group of medium aggressive multinationals who are most affected by country reporting. So yeah, I think we're all aware of the size and the estimates of profit shifting and how big of an issue it is. And CbCR adds some transparency in these activities of these multinationals in the fight against profit shifting and corporate tax avoidance. So I think we've seen a lot more estimates of the size of profit shifting than these, but it's clear that it's a big and increasing issue. And fortunately, internationally, there are initiatives to fight this, including the OECD BEPS project, which most importantly in this conference led to CbCR, which has also led to a lot of great research, which is amazing to see these 2 days. So yeah, we've heard this before. The objective of CbCR by the OECD was really to provide tax administrations with the high-level overview of the operations and the tax risk profile of large multinationals. So this should provide tax authorities some additional information we've seen, which they can hopefully use to more effectively fight profit shifting and corporate tax avoidance. Yeah, so we all know about the implementation of CbCR in 2016, and because I will be using an RD, the 750 million threshold is quite important. And yeah, obviously it's not public yet, CbCR. So the effects that I'll be presenting today are really effects of the additional scrutiny by tax administrations and not public scrutiny. So yeah, the hypothesis that we developed is that yes, if these tax administrations can use this information to more effectively fight profit shifting and corporate tax avoidance, then CbCR should have kind of improved tax compliance by multinationals. But if it's not enough, CbCR, if the benefits of avoiding taxes still outweigh the costs, despite the additional detection risk, then the most aggressive multinationals will probably still shift their profits and avoid taxes. So I hope you can see this. This is kind of a picture of the main idea of our hypothesis, where we basically base it on a classic tax evasion model by Ellingham and Senmo, where multinationals just do a cost and benefit trade-off in deciding whether to shift profits. So the benefits we assume are increasing in the aggressiveness of a multinational, and the cost curve, well, we have here depicted as a horizontal line, but methodologically it can be somewhat increasing as well, or have a different shape. But the main idea is that the costs of profit shifting, of avoiding taxes by a multinational has increased because of the introduction of CbCR. So the detection risks of these aggressive strategies increased. So there is a group of firms, at least, for which the increase of detection risk, cost of profit shifting was enough to offset the potential benefits. So these multinationals will have been affected by CbCR and increased their tax compliance. However, if there is a group of very aggressive firms with very high benefits, very high payoff from their aggressive strategies, then CbCR may not have increased the cost of these aggressive strategies enough to offset the benefits. So the most aggressive firms here may not be affected by country reporting in its current form. Right, so we're all aware of, I think, the literature as well on the effects of CbCR. So two most closely related papers are the one by particular Joshi and the one by Felix Hügge, who both also find a positive effect of country-by-country reporting on tax compliance. They do so in some different ways. I think we'll follow the methodology by Joshi a little bit more. And what we really add to these papers is this heterogeneity analysis, so that we show that yes, CbCR has had some positive effect. It's decreased tax avoidance, but we probably should do more, because the most aggressive multinationals are less affected, so that the most compliant became even more compliant. So it may have actually increased some kind of inequality between these entities as well. So yeah, we use effective tax rates basically as a measure for tax avoidance, and then we employ a sharp regression discontinuity at the 750 million threshold in revenue, where we use an optimal bandwidth selection procedure. So in an RD, the bandwidth is very important, and results are usually very sensitive to the actual choice of the bandwidth. So we optimize this with a bandwidth selection procedure that kind of leverages the trade-off between bias and variance that you have in this bandwidth selection. So when a bandwidth is too small in an RD, then you use fewer observations and the variance of your estimate goes up. But if you use a bandwidth that's too wide, then you get over smoothing. So you might introduce a bias in your results. And actually the mean squared error of an RD estimate is kind of a sum of the bias and the variance. So if you minimize this, then you kind of do a trade-off between this bias and variance and optimize the bandwidth for your results. So that's what we do. Some additional methodologies that we use a triangular kernel to add more weight to observations close to the threshold. This doesn't really change the results very much. Yeah, you have to correct your estimates, of course, if with your bandwidth selection, you kind of admit, okay, there's some kind of bias that we have in these estimates, then methodologically you should also try to correct for this bias. So that's what we do as well. Yeah, we add some firm fixed effects and other fixed effects, some control variables also to add some precision to our estimate. So in an RD, you shouldn't really change the size of your estimates, but they can increase the precision of them. That's what we'll see in the results. I think, yeah, let's go to the data first. Yeah, I used the Blue Open Dykes Orbis for this. So basically, well, we know this data. Yeah, I have a Vermeer panel at least in the implementation period for 2016, 17, and 18. I also have the pre-implementation data for a falsification test. And then, yeah, annual revenue, of course, is the running variable in the RD. And the outcome is effective tax rates. And with the ownership data, we construct a dummy for each M&E indicating whether it's operating in a tax haven, so whether it has an affiliate in a tax haven. And we use different tax haven lists or specifications, but the main one we use is the same one as this, the Simone and Albert, which is a combination of the one by Benetton and Zoyme and Tax Justice Network and classic Heinz or Rice list as well. Yeah, so for the RD, of course, to be valid and to provide causal inference, we need to rule out the option that M&Es avoid their reporting obligation under CbCR. So we test for bunching with the McCrary test around the threshold. You see that basically the density of multinationals around this revenue threshold is as good as continuous. So we find no evidence for bunching and for avoidance of the reporting obligations. So moving on to the results then. Quickly visually, that's always nice in an RD. Here, the pre-implementation, you see that there is essentially no jump in effective tax rates around the threshold. So this was before CbCR. There should be no difference between being just above 750 or just below 750 million. But in the post-implementation period, so with the introduction of CbCR, there's a clear discontinuity in effective tax rates around the reporting threshold. So we also see this in the actual regression results. There you can clearly see the size as well. So first, maybe the bandwidth, the optimal bandwidth is almost 200 million around the threshold. So multinationals included here range roughly from 550 to 950 million in revenue. So maybe that's rather large, but yeah, still don't get too many observations here. Yeah, estimates are quite consistent, 5 to 6 percentage points, and they get more precise as we add more controls and fixed effects. So this is a clear increase in effective tax rates because of country report. So an increase in tax compliance. Yeah, and also in the pre-CbCR period, there's no significant difference around the threshold. We perform the same RDs with some alternative bandwidths, of course, to see whether this effect really only happens when we use this specific optimal bandwidth. But it's really quite robust. So we add 25% to the optimal bandwidth, or we take off 25%. Yeah, the results are still quite clear and positive that there's significant increase in effective tax rates because of country by country reporting. So this kind of corroborates also the results in Joshi's paper, who also finds roughly 5 to 6 percentage points increase in effective tax rates. So that's encouraging. And then we move to the heterogeneity analysis. So it's rather simple, actually. We just basically divide the sample in 4 subsamples based on two indicators. So whether they had a low or high effective tax rate before country by country reporting. So a low effective tax rate would indicate that they were already aggressive before country by country reporting, probably still since, and whether the multinational is present in a tax haven. So with a high effective tax rate, independent of tax haven presence, we say, okay, these multinationals are not really aggressive. So even if they might be present in a tax haven, their relatively high effective tax rate indicates that they're probably located in this tax haven, not for tax avoidance reasons, more real activity there is likely. And then for the firms with a low effective tax rate, we say they're most aggressive when they're also present in tax havens. And then we just perform the same regression discontinuity on these 4 subsamples. And the result is quite clear here that these non-aggressive multinationals, they are not affected by country reporting. So that's intuitive. Of course, these had a high tax rate already. They weren't shifting their profits. They weren't avoiding taxes. So they're not affected in their effective tax rates by country reporting. So the effect is fully concentrated in the more aggressive multinationals, but within this group, it's really concentrated in the medium aggressive group. Here, the estimate is a lot higher and a lot more significant. So multinationals with a low effective tax rate and presence in tax havens are probably still avoiding more taxes or shifting more profits after CbCR than the slightly less aggressive counterparts. And this is robust to using different tax haven specifications, tax haven lists. So here I've dropped the non-aggressive multinationals, but I've shown the results for medium and high aggressive multinationals. Well, for 2 different tax haven lists, so by Javier and Gabriel, and we kind of see the same qualitative picture, at least. And using the corporate tax haven index from 2019 even gives us a 0 result for the most aggressive multinationals. So clearly, these most aggressive ones continue to avoid taxes more than their medium aggressive counterparts. Yes, perfect timing. Final slide. So just to conclude, is that yes, CbCR, even in its current private form, is somewhat effective in deterring tax avoidance and into countering profit shifting by large multinationals. But we have to be careful to be too optimistic and too positive about this. This effect is driven by some medium aggressive multinationals. It maybe doesn't hit the worst offenders. Policy implications are basically that if we want to fight profit shifting more effectively, we need to do more. So we all know about potential public country by country reporting, Pillar 2 minimum effective tax rates. These are all instruments that might be necessary to more effectively hit these most aggressive multinationals. Thanks very much. Yes.
And thanks for a very interesting paper. I have one question and one question. So the question that I was asking myself, and I was thinking about this was the previous more general question. And if in this replace the word, the expression CbCR with BEPS, I mean, would that change something? I mean, 2016 is when BEPS really kicked in. So we had a feeling that it was something concrete, and as part of that, there is CbCR. So I'm wondering if this kind of study can be really thought as something that identifies the effects of CbCR, of that specific part of that, or it's just, it reflects the workplace. These things were changing under methods. So this is just a curiosity, to really frame correctly what this kind of study really says to us. It's the kind of BEPS, not the kind of CbCR. To me, it's not evident, it's just BEPS. And the second consideration is this one. You have a big effect for what you call medium aggressive enemy. And the medium aggressive enemy of metrics, we look at the tax rate and we know presence in the data. So, this is the category where I'm most skeptical because that kind of combination, to me, it's more associated with multinationals that were very good and benefit from tax incentives, for example. And from the rest of the world, and so on and so forth, which is a big issue, but it's something different from this. We don't be so sure to identify people. To identify the some of as aggressive in terms of tax avoidance and partnership. We just have ministers that were more liquid than others. Instead of the presence in tax haven, then it's really negative because we don't have investment. We have investment that is that benefits from low tax rate. You have a place where you know that profit shift occurs. So that's the consideration.
Yeah, thanks. That's very interesting, and I think I agree that we should be very careful in how to actually attribute this effect and this finding. Maybe it's more an effect on these firms that they become less good in using these tax incentives to decrease their tax rate than an effect on profit shifting specifically. So in general, maybe it's more an effect on just effective tax rates than specifically profit shifting. I agree. And then just quickly on your first remark, I agree that there's a big change in the world of corporate taxation. So there might be many effects, but so that's, I think, the advantage of this RD, that we really compare very similar multinationals. What we see is really an effect of being just below or just above this reporting threshold. So yes, if these MNEs perceive being just above or below as more risk than just having to report their CbC financials, then it might be a broader effect than just CbCR, but it is really at this threshold with really similar firms. Yeah.
I'm very similar thought. I think the label medium aggressive and high aggressive is not right here. I think it's aggressive with shifting opportunities and aggressive without shifting opportunities, the way we've got it done. And it's actually fascinating that it's the high tax or like the firms that are getting these incentives and getting deals in what we would think of as high tax countries that are changing their behavior.
Yeah.
That's novel. I mean, that's I'll ask one technical question. Are you doing your ETR sorting, your ETR ranking within industry, or are you just doing it across the whole?
I've done it both within country year and within industry year.
And the results are with
These are, I think, within country year. Yes, but I've done both and they look similar.
It's a question of clarification. Maybe I missed this. When you identified the M&Es that have no tax haven subsidiaries, how were they identified? Did they never have any, or?
In this, also, I've tried different specifications. I've tried in the previous year. I think in the specification, it's in the current year with these results.
So right before CbCR.
No, during CbCR. Yeah, but I've also done it with before CbCR, and again, the picture looks similar.
Yeah, the concern was just, well, are they changing?
Mm-hmm. Yeah, so we know from the literature also, of course, that some multinationals close down tax haven subsidiaries. Yes, it doesn't change our results really.
No. Thank you very much.
So, welcome back. It's a pleasure to introduce one of the highlights of our conference. It's an honor to have Kim Clausing with us here today. And although she really does not need an introduction in a group like this, I'll provide a brief introduction. So if you're working on taxation of multinational corporations, which I think basically all of you are, then you have read and used research Kim has produced over now already a few decades, if I may say. She's PhD from Harvard University and spent most of her academic career at the Reed College, and now last year she moved to UCLA. She's written a book, Open: The Progressive Case for Free Trade, Immigration, and Global Capital. So those of us who have not read it, we should all feel welcome to do so. One of her many important roles is that she was so kind and agreed to be on the advisory board of CorpTex. So thank you, Kim. And while some of us talk with policymakers or try to influence policymakers, she has become one of them for a recent period of time. So during the first part of the Biden administration, and most of you know, Kim was the Deputy Assistant Secretary for Tax Analysis in the US Department of Treasury, serving as the lead economist in the Office of Tax Policy. And she's also been interacting over the years in many other roles with the policy world. She's now a fellow at the Peterson Institute of International Economics. She's a member of the Council of Foreign Relations. So I can hardly think of anybody better suited than Kim to give us a keynote lecture titled "The Future of International Tax Cooperation." So the floor is yours.
Thank you so much for that kind introduction and for your work on this conference and for this invitation. And thanks to all the other organizers and presenters. I feel very honored to be here and to talk about this topic with all of you. And I've learned so much from your work, and I look forward to learning from it in the future. So I chose this topic, the future of international tax cooperation, in part not because I can prognosticate what the future is, but rather I thought it would be nice for us to set some of this research in the context of why this is important. So what do countries benefit? How do countries benefit when they cooperate on international tax? What do countries want? What do governments and their people want from taxing multinational corporations? How is it that we build successful multilateral action to do things like require country-by-country reporting? And then also to ask whether the international tax agreement has fulfilled its promise in this respect. What are the prospects for it? What did it achieve so far? Where did it fall short? What might happen in the future? Again, I don't have the key to the future looking, but I have some ideas there and some lessons that we might draw from this experience. So first, starting with why we went down this path. I mean, this first statement might seem a little harsh, but I think it's accurate. The system is intellectually bankrupt, enormously complicated. It loses revenue, it reduces efficiency, and it turbocharges inequality. That's the sentence I came up with on the plane. But I do think it might be a useful way to evaluate both where we are and where we might want to be, right? So I would argue that reforms could hope to address some, but not all of these things. So for instance, the international tax agreement, if we wanted to look at it, we might judge it as doing 3 of those 5. Deficiencies might be somewhat remedied. I'm not sure we're ever going to get to 5 of them. It's very difficult to imagine the kind of wholesale reform that would do all 5, but we might settle for things that can move us towards improvements in these dimensions. So first, why do I say it's intellectually bankrupt? I think really, if you go back to when you first learned about what a multinational corporation was, right, the question you might have in your mind is, why do they exist at all? Why don't companies just sit in their countries and export, or do things at arm's length, license their IP to people in other countries? It seems like a lot of bother to set up all of these affiliates, right? And so we think that they exist because they are more profitable together than they would be separately. And if they're more profitable together than they would be separately, then that implies already that the arm's length pricing is a fiction, right? Because there's going to be some extra profit above what you would have if you were transacting at arm's length. Right. And all of us who are in families know that, like, parents and children don't always do things at arm's length, right? We have reasons to promote the collective rather than to treat each other distantly. And the same is true within the firm, right? One of the advantages of being multinational is you can take the principal agent problems that would otherwise occur and put them within the family, right? And do your best to maximize profits. Right. And because companies can do that, they can also do that with respect to tax. And tax provides a really important internalization motive, right? By having it within the firm, right, you can lower your tax burden to what it would otherwise be, right? And because of that fiction, we've ended up in a situation where profit is very obviously misaligned with the true source of value. As we saw yesterday in the German data, you've got $400,000 worth of profit per employee in some jurisdictions, but not worldwide, right? We see similar patterns in the US data as we see today, and in data from other countries, right? I could go on about other features, the permanent establishment. It's not clear that should be relevant. Like, is physical presence really required to generate value in a modern economy? It's not clear that it is. But, I think the arm's length standard kind of gets at the heart of what's kind of causing some of this intellectual bankruptcy, as I would put it. Now, how did we end up in this situation? Well, I think there's a lot of different factors. Like, if you go back to when the international tax system was first really set up in the early 1900s, right? Companies were a little more brick and mortar. Like, you could see where things were a little more easily. They were a little more domestic. It's true they did cross borders. Like, there was a lot of globalization in the past, but there wasn't quite the technical ability to have something like intangible value that has a very ambiguous location and to just sort of say, well, actually it's in Bermuda or wherever it might be, right? So I think globalization and tangible value are part of the economic reasons we ended up here. But governments also contributed through lax regulatory environment. Take the US check the box, right? That is an environment that enables entities to be disregarded for tax purposes in a way that facilitates tax avoidance and also facilitates an advantage for some companies relative to others, those that can exercise that ability. Tax competition has been really prevalent. We've seen this long secular trend towards lower corporate tax rates. Some people aren't bothered by that because they're like, well, revenues are still doing okay. But we have to keep in mind that corporate profits as a share of income have been rising over this same period. So we would suspect more revenue from the sector, not stable revenue. So the fact that the revenue is stable and the rates are declining, right, is partly because the base is increasing. So I think that, governments have been complicit in this problem. And finally, of course, there are plenty of people who make their living this way, right? They view tax avoidance as a profit center of the company, right? And some of it is, all of it almost, is probably perfectly legal. Maybe not all of it, like some of it does go a little over the line. Like the IRS, if they were well-resourced, could probably win more cases, right? But, a lot of it is perfectly consistent with the international tax law that I now teach. It's like, here's the ways you do it. It's like the textbook spells it out, right? So, I mean, it's not all that surprising. So why do we need international tax reform? Well, because this is sort of an unsatisfying place to start. Why do we benefit from cooperating? Because there's a prisoner's dilemma, right? Like, what's in the interest of the United States? Acting alone, thinking only of itself, is not necessarily consistent with what's in the interest in the United States that has the ability to coordinate with others, right? And the same is true, of course, for the Czech Republic, the EU, Japan, any number of countries, right? And so we can hope to get past this prisoner's dilemma through cooperation to get a better equilibrium than we could have if we all operated individually, right? And of course, it would be nice to avoid double taxation. That's something we've been pretty good at doing since the system was set up. I don't think there is a lot of double taxation. But of course, also nice to avoid double non-taxation, to implement something closer to the single tax principle, where we think income should be taxed somewhere, right? So I think those are all reasonable objectives. Just a picture or two of the source of the problem, or the, one visual of the problem. This is country by country data from 2017. It's a little bit of overcounting in the 2017 data in the foreign side, but not as much as we see in 2018 and 2019. But you do see the big locations for US multinational profit. These blue countries are ones with effective tax rates that are quite low, but are very small countries in the whole scheme of things. The yellow ones are ones we think of as like kind of big economies, where the US multinationals should have a lot of profit. So you do see some misalignment right there. These data don't have double counting, but are measured at like the last point of entry before the United States. But what you see here, I think I'm more interested in the trend, and these are the only data I could get all the way into 2022. So these are the foreign direct investment earnings. And the trend is what I would point to, right? You see this rising share of the foreign direct investment earnings that are in very low tax jurisdictions. Very flat, kind of from the period of 2015 to 2019-20, but then a little dip down in the last couple of years, right? And so that might be the work of GILTI. I think the jury's a little out on how effective that's going to be, but it does look like there's been some leveling off, perhaps due to Tax Cuts and Jobs Act. Okay, so why do countries care? I think there's many reasons to care. One is corporate tax base erosion. There's less revenue. And revenue is a big deal these days. It should be a big deal always, right? There's a lot of things governments can do with revenue. I think it is difficult to take any single data source and say, this one is the truth, right? Every data source that I've used or seen used has some flaw, right? So I think the best we can do is sort of look across a lot of data sources. So this 2020 paper that I wrote, I used 4 different data sources and 4 different methods. And I'm like, oh, it could be as low as X. It could be as high as Y. X and Y are actually pretty different, but they're both large, right? And I think I've given you 4 numbers here, which are 10-year revenue estimates of the Biden country by country tax reform in the United States. And that would have been at 21% country by country minimum tax. So it's quite different from 15. And it's not so much that these numbers are that interesting, but what I would point out is that they're all large and that there's a big range, right? So Treasury and JCT, I think, would be sort of the gold standard, and that they get every type of data. So they've got the 5471 data and the 8975 data. They've got it for a level. They can compare it using Orbis and CompuStat and anything that they would want. There's like 50 of them. They're doing very good work, like in both JCT and Treasury. And so I think those 2 numbers, you'll notice, though, aren't the same. Like, they're pretty different from each other. So there's still a lot of uncertainty here about what revenue would be generated. And I took all of these from a very similar moment in time, which is spring of 2021. But they're large, right? And I think the only point I'm trying to make here is that there is money to be had. Governments need money, right? And this might be an attractive source of revenue, given that some of the others fall much more heavily on workers. But I do think the data sources are imperfect. A second reason that countries might desire reform is they want a system that's more fair. Now, fair is a really hard word to describe. There's multiple types of unfairness that we might see from this status quo. One is really in the competitive landscape itself, right? If large aggressive firms have lower tax rates than small compliant firms, right, then the playing field of competition and capitalism isn't quite level. Like, we're sort of giving the big firms an extra boost relative to the little firms. And economic theory would suggest you want to do the opposite, right? Society doesn't necessarily benefit from having everything agglomerate in these big, large firms. You can go all the way back to Adam Smith. I was just talking during the break about Adam Smith's distrust of very large corporations, and it's partly because they suppress competition, right? So we might think, if anything, we'd want the big firms to have higher tax rates, not lower ones. But we also see a competitive advantage for some countries' headquartered companies relative to others, right? And it's not always exactly what you would think. In the same time period that the US had a 35% corporate rate and purported to tax the worldwide income of its multinational firms, we also had some multinational firms that achieved single-digit rates through very effective use of very complicated chains of ownership, right? And so if you're competing with a US company, right, you may be at a disadvantage if you aren't able to use those same techniques. Another type of equity that we might be concerned about is the equity of the tax system itself, right? Profits are disproportionately held in the hands of those at the top of the distribution relative to labor income or relative to sales tax sources of revenue. And so when we lighten this tax burden, as we've seen in many countries, it requires a greater share of the relative tax burden to fall on labor. And this is during a time period, of course, where capital is becoming a rising share of national income, which has been documented by the OECD and others. We've seen in the United States, there's like 4 different sources of income that show somewhere between 6 and 12 percentage point increase in capital share of GDP. But this is a trend that's true across rich and poor countries, kind of throughout the world. So that's tricky. So you might say, well, multinationals are mobile. People aren't. So just do the capital taxation at the individual level. Why are you trying to tax companies? Right? We could just tax the shareholders themselves. And I'm very sympathetic to that argument because I love inelastic tax bases, right? Like we should all love inelastic tax bases. And the multinational companies are elastic tax bases. But let's say you tried to do this in the United States. And this is data from the United States about how much US equity income is even able to be taxed by the US government should it want to. Right. So we've got sort of 3 sets of reasons you can't tax it. It's held in the hands of foreigners, and we have treaties that say they get to do it. Right. It's held in non-taxable accounts, your pensions, your IRAs, your college savings accounts, or it's held by non-taxable individuals like endowments. Right. If you add that all up, it's now this data. These data come from a paper that I published with Len Berman and Lydia Austin a few years ago. But if you go forward, this trend continues. Less than 30% of US equity income is in taxable accounts. So you could say, okay, well, we love nonprofits and we love retirees. So maybe we just really hammer those 30%. Right. But that's difficult too, right? Because remember, we don't tax capital gains until they're realized in many environments, right? In the US, you also get stepped up in basis at death, which Kevin agrees is like a kind of a silly thing. But that means a lot of individual income, even in these taxable accounts, is escaping taxation, perhaps forever, right? So I think that's one reason we're all in this room is that, like if you want to if you want to tax capital income, the entity level makes some sense. Another reason we might be concerned, or why governments might be concerned, I know that we're kind of like dispassionate academics, but if governments benefit from the perception that what they're doing is fair, right? And so in some countries and at some times, there's been a lot of light shined on the fact that it looks like the system isn't always perceived as fair. Like some companies can get really low tax burdens. That creates worry that like, well, should I pay my taxes? Like, is it really fair? Like my first dollar, gets taxed at this rate and they're getting this lower rate. I do think having a progressive tax system is useful to sort of offset a lot of the disruption that we see around ourselves that tends to fuel, populist policy drives that aren't always in the national interest. So take, for instance, protectionism, right? Like it might be really lovely politically to tell people that, oh, we're going to be America first, or we're going to make it in America, or we're going to do these things, right? But that might actually make the workers that are receiving those policies in the form of regressive consumption taxes and extra labor market disruption, it actually might make them worse off, right? So we kind of need thoughtful outlets to that sort of populist, dissatisfaction with the sense that the system is rigged. And so I think it's important to be able to have, progressive answers to that aren't let's bully other countries or let's look inward, right? And that's part of why I asked, when Petra asked me, like, what should I say in the introduction? I was like, oh, you don't say much, but you could mention the book because the book makes this argument, and it's meant to sort of make, the economic literature around trade and openness a little more accessible to like your brother-in-law or somebody who might be skeptical. So I do think that these are all things that sort of help drive this urge for international tax reform. A final consequence we might think about of letting the corporate tax base erode is that the corporate tax has the potential, at least, to be a very efficient tax. Now, many people are not of this opinion, so let me just clarify. So many people are like, well, the corporate tax is a bad tax. It's like very distortionary and we should tax people, not corporations. And why would we discourage investment? And therefore we let this thing wither away through self-help or tax competition, all the better, right? However, right, if you look at least the US corporate tax base, which these authors, Fox, Power and Frerick, and a group of IMF economists have done, you see quite a bit of overlap between the current US tax base and the one that would apply if we only targeted rents, right? If we completely exempted the normal return to capital. And the reason that is because to some extent, the system does exempt the normal return to capital. Anything that's debt financed, that is deductible right away. And you can see that any investment that would be worth doing on a pre-tax basis is also worth doing on a post-tax basis if it's debt financed, right? Expensing is allowed, completely write off capital investment for structures under recent law, right? That varies a bit year to year. I'm sorry, for equipment, not for structures. And structures might be double taxed if they're equity financed. So it's distortionary in the sense that it depends on how it's financed and what the investment is. But there is an enormous amount of overlap with pure rents tax. And frankly, you could do just a couple things to make it overlap even more if you wanted, right? You could eliminate the deductibility of debt and couple that with expensing, and then you're basically there. Like then you've got something that looks a lot like a rent tax and it raises almost identical amounts of revenue if you don't change anything else. Right. So why do I mention this? Well, I think the corporate tax base is extremely concentrated. In the US, for instance, I just got these data from the IRS for 2019. 350 of the 500,000 corporate taxpayers are about 70% of the base. Right. So, and if you go up to like 1,500 taxpayers, right, you get 87% of the base. Right. So it's a very concentrated tax base, and we're in an environment, and this is from DeLuca and Eckhout's paper, we're in an environment where there's a lot of evidence that not just in the United States, but in the EU and throughout the world, that there's rising market power, right? So rising market power means it's, like maybe that's not necessarily good for things like the labor share of income and the health of capitalism, right? So maybe if we can make this tax a little bit more like a tax on rents, right, then we can also have an efficient tax, right? And even in its current form, we have reason to think, and Fox and Power and Frerick think that, for these multinational companies, probably 85% or so, Fox has a higher number in recent years, Power and Frerick are closer to 85%. Of the tax base is above normal returns to capital, not the normal return. Okay, so we have some reason to care, I hope by now, about why we might want to cooperate on these questions. So what do countries want from this international tax agreement? I mean, I think they want to overcome the collective action problem, right? There's a strong sense that countries can't unilaterally do this. In the United States, which is probably the country most suited to unilaterally do this, both by disposition and by size and by the fact that we host the most profitable companies in the world, the headquarters of those companies, like we are very reluctant to do this unilaterally, in part because of this competitiveness concern. The companies come in, they're like, hey, you do this to us without doing it to everybody else. Like we're going to be really disadvantaged, right? So getting the people together to do this is important. I think revenue is a real big objective. I think the first round of BEPS was unsurprisingly in the preface documents, they talked about the financial crises that affected the United States and Europe and the world that made revenue a key desired objective. I think more recently, COVID has filled that a need or that sense that revenue might be important, right? Governments spend a lot on trying to insulate their populations from COVID, and we're now living with some of the consequences of perhaps overkill in that regard. But there are large deficits, there's large debt, and there's reason to have the revenue, right? So there's a lot of interest. Now, there's also interests that vary, right? I've presented a picture where everybody should want to fix this problem, but not everybody wants to fix this problem, and they have different interests. So some countries are headquarters countries, right? And so they might think, well, somebody's going to tax our firms, it should be us, right? Some countries are primarily host countries, right? They're like, well, we've got these multinationals coming in, but we don't have a lot ourselves. And some are both, right? And I would say, in the United States, it's clearly both, right? And if you look at the Pillar 1 consequences for U.S. revenues, they're about zero. It's like we lose some, we get some. It's not as consequential. But a lot of countries aren't both, right? They're more one or the other, and that affects their incentives in these agreements. There's a strong desire to have the ability to provide tax incentives, particularly in some countries, right? And so there's a tension in this agreement between people who think it would be nice if we could all agree, tie ourselves to the mast, so to speak, if we could all agree to just subsidize the companies less, right? And there are some who are like, well, no, that's part of our development strategy. We definitely want to be able to subsidize companies. We understand we don't want to necessarily leak all the revenue out of other countries, but we want to be able to have real incentives, right? So that's a big tension in this. And there's also a tension between jurisdictions. Some of those very low tax jurisdictions have followed a strategy for which that's very good for them, right? I do think, they're not necessarily the obstacle that you would think. Interestingly, in Europe, it wasn't Ireland and Luxembourg and the Netherlands that stood in the way of the directive, right? It was Poland and then Hungary, right? And so that weren't necessarily the countries that you would think would get in the way. And another big interest is tax administration, right? The United States has its own problems with IRS funding and the ability to do things. But imagine you're trying to administer an incredibly complicated system in a poor country, right? That's very hard to do. The outcome of the first round of BEPS negotiations was 1,900 pages of guidelines. If you look at Pillar 1 and Pillar 2's texts, right, they're starting to be large. So, complexity is another issue that's here. Okay, so the key ingredients to multilateralism that kind of enabled this agreement to come together in 2021, I think, are four. One is a common recognition of the problem. And I think this is what this group is sort of working on getting a more precise answer to. How big is the problem? Is it a problem? I think we get to the point by 2013 to 2015 where most countries think, yeah, it's a problem. Maybe we don't know exactly how big it is, but it's big enough to want to solve. Right. And I think BEPS round 1 really does lay the groundwork for this, including in the data area. The second is a willingness to do something more transformative and less incremental. The first round is a little bit of tinkering around the edges. It might seem substantive, but you can't really see it that much in the data of enormous changes in company behavior. This one starts with the idea, we're just going to handle digital issues that we didn't quite figure out, and we're going to do the remaining stuff. But it turns into something that's pretty big, right? Digital turns into, in part, a reallocation of taxing rights. That is transformative. That is not the normal thing to just be oh, yeah, the market can have some. That violates this sort of notion that you have to have physical presence, but it violates it in the name of something that seems economically sensible. It makes it perhaps a little less of a disconnect between where the activity seems to be and where the taxing rights are. And Pillar 2, which is also, I think, pretty transformative. It's basically going up from the premise wherever you earn the income, wherever, it should be taxed at least 15%, right? So there's an enormous amount of negotiation around what should that rate be and how big should the carve-outs be. But there is a commitment to things that I would say are sort of transformative, not the kinds of things I could have imagined 10 years ago, much less 20 years ago, right? Third, I think a really crucial factor of this agreement that may actually be the thing that saves it in the end is this enforcement mechanism, the under-tax profit rule. Because if the EU, as an example, or say the UK, Canada, and Japan, it doesn't have to be the EU. If we get a few important countries to adopt, right? And they also implement this undertaxed payment rule, then the non-adopting countries basically have a choice, right? They can subject their companies to tax themselves, or they can let other countries do it, right? But it's not like the companies will escape taxation. And that's a really important mechanism that will create sort of a snowball effect if you can start the snowball. Right, like there is this problem of chicken and egg, like who will move first, right? But if you start moving, I do think that helps. And finally, I do think that it was an auspicious time in 2021 for leadership. You know, you had the ability of the U.S. government to think more multilaterally than they did earlier. Like Pillar 1 and Pillar 2 ideas were out there, and the prior administration was like, yeah, maybe the U.S. can do it in a voluntary way. Right. And that kind of takes the teeth out if you're like, you might do it if you feel like it, you know. And so I think with the change in administration, with the French presidency of the EU upcoming, with like a bunch of sort of auspicious opportunities, the interests of the German leadership, there was a strong leadership drive by the Germans, the French, and the Americans and others, Japanese and other countries to sort of help this happen at that moment. So in the fall of 2021, you got over 135 jurisdictions representing about 95% of world GDP to come to a political agreement, right? Which is kind of astonishing. I mean, so we should take a moment to be like, that's a pretty big deal, right? On these two pillars, right? Now, I was just at a thing last week at Stanford where Ellen Auerbach put up the slide. It's like 135 agreed. How many have implemented? 0. And so he was like, hey, it's dead, folks, right? And luckily there was some other guy from, I think, KPMG who was like, well, all the companies are planning for it. It's probably not totally dead. Is it dead or not? You know, like that's an interesting question. We do have this disconnect between 135 saying they will do it and 0 doing it so far. But, you know, life is long. Like so far isn't necessarily like the measure of success, right? The U.S. had hoped to implement this. The U.S. Treasury did have a role in negotiating, especially the secretary. But the U.S. legislative process, I think, is one of the most difficult in the world to get things done, including the fact that it was a 50-50 Senate, right? The EU is mostly enthusiastic, but the directive requires unanimity. First Poland and then Hungary has been less than enthusiastic. I think 5 countries said they would go forward: France, Germany, Netherlands, Spain, and Italy. But there is this fear of moving first. So what does the agreement achieve and where does it fall short? So I think what it achieves, and notice the parenthetical, the US Treasury, it was commonly on record as saying like this will end the race to the bottom in corporate tax. And it does in some respects, right? Not in every respect. Like I think we know that the incentive to provide companies with incentives is a very strong one. And it's not one that you can completely undo with one agreement. And it's hard to undo when the WTO, for instance, which is a natural forum for countering harmful subsidies, is in such a weakened state with insufficient judges to even implement dispute settlement, right? So we've got a lot of different forms where we might think about this pressure and how to alleviate it. But in this particular one, in terms of the setting of rates and thinking about the base, progress is being made here to reduce the race to the bottom. That should reduce profit shifting incentives if implemented, but in a way that's consistent with competitiveness, right? And this is important, right? Because the thing that's preventing action in this is often companies being like, you can't do this because we will be crippled on the world economy. And then if you can go to the companies and be like, well, not to worry, we got 135 countries to do it, right? And then they'll be like, well, fine, but don't go first, right? And that's what they say everywhere, right? But then, nobody goes first, which is a little bit of a problem. So Larry Summers called this a triumph of Detroit over Davos in his op-ed about it. And I really like that line, not so much because I'm anti-Davos, but because I think it's part of shaping tax in a way that's consistent with what the global economy is. And saying like, in order to have a global economy that works for workers, that is good for inclusive prosperity, we also need to be able to do simple things like tax capital, right? And we've been pretty bad at taxing capital, right? And so this is a big step forward in that regard. So I do think it's a big deal. It did fall short, right? This only sort of is true. Like it explicitly allows, for instance, refundable tax credits. And so you might imagine, well, countries could just convert the tax competition pressures into refundable tax credits. Now, I would point out, while true, a refundable tax credit is not an easy thing to afford, right? If you're giving companies a refundable tax credit, you're basically telling them, like, even if you earn nothing, I will cut you a large check for that activity, right? And there might be some things for which you're willing to do that, like green electricity, right? Leaps to mind right now. But it's not clear you want to do that for everything, because the government has to basically become a cash machine, and there's no like kind of limit, right? You could have a company with nothing going on that gets this refundable tax credit because they've just done the chosen activity. So I do think it doesn't end the race to the bottom, but it makes government at least pause before engaging in this tax competition. We might worry that, did the source countries get a fair share of revenue? It's like kind of random. A lot of the numbers that were the outcomes of negotiation. So for instance, this amount A in Pillar 1 is 25% of the residual profit. The residual profit is above a 10% return, right? Those numbers, 25 and 10, could have been 50 and 2, and it would have just as much like economic meaning. Like maybe the market should get half of the residual value. Maybe the normal return to capital in a low inflation environment is 2%, not 10. You know, like you could argue that that's closer to the 10-year treasury, right? So I think some of this, we might worry a little that the political power of those negotiating the agreement shaped it in a way that isn't always fair to source countries. The new rules are quite complicated. The old rules were mind-numbingly complex. The new rules are like also complex, right? We're getting a system that's extremely complicated. It's certainly a full employment act for, you know, accountants and lawyers forever. And then there's some questions about these two pillars and how they're tied together and what happens if they separate. Pillar 1, we think, requires treaty modification because it's changing taxing rights. Pillar 2 doesn't. So Pillar 2 has an easier road than Pillar 1. And Pillar 1 has a particularly hard road in the United States because treaty modification requires a number of senators that it's going to be difficult to achieve unless the business community wants Pillar 1 to happen. Right, which they might under some circumstances. So we'll get to that. So what happened? The United States passed legislation that looked really compatible with this agreement in November of 2021. So it looked like all we need is 50 senators, and like the US moves first, right? We had, 48. As it turned out, not quite 50. So the Senate, by the time, for a while, it just looked like nothing would happen. But by the time the Inflation Reduction Act happens in August, this minimum tax that was a GILTI reform that was approved by the House has turned into this other thing, this corporate alternative minimum tax, which is not Pillar 2 compliant. No one thinks it is. We might think it could be like a bargaining chip or a stepping stone, in the sense that you could say to the business community, let's say others adopted, you could say, okay, do you really want to pay 3 minimum taxes, the GILTI, this thing, and the UTPR in other countries, or would you like us to reform GILTI and then you'll be down to 1, right? So you could imagine it being useful in that respect, but it certainly wasn't getting there. And then in Europe, I think people have been distracted by war and other things, right? And it's not like the tax people are spending a lot of time thinking about that. But I do think, there's more pressing issues for some, right? And, there's some countries that want to go ahead without unanimity, but it's unclear, like that takes more time, so it's a little unclear. And then there are countries throughout the world that could also adopt, but like we don't really know. So I think I'm almost to the end here. I think I have 2 more slides. Possible futures for international tax. I'm an American, so I wrote this from a kind of a US perspective. So abroad is now not America. So leadership abroad would be other countries adopting, right? Which could be either the European Union or it could be a collection of other big countries, and the US eventually acquiescing. That's not going to happen in 2023, I would suspect, or 2024, but it could easily happen in 2025 because we know we're going to have tax legislation that year because a bunch of stuff expires. for obscure reasons that I don't want to go into. And the undertax profit rule could be a big incentive, right? So you could imagine the US following, and not following in all things, like we have a guilty already, we've done some stuff, like other countries do it, and then we conform later, right? And the current corporate minimum tax could be a bridge in the sense that we could exchange it for a reformed guilty. It's also possible, I got this one with US petulance is a thing. Like I can imagine certain administrations in the past wouldn't necessarily respond well to that, right? So if there were a Trumpian sort of administration and this thing happened and other people started taxing our companies, they might just be like, well, how about a trade war instead, right? Like, and I'm hopeful that that's not the future, but I can imagine it, right? Like that's a possibility. I think it's actually the most depressing perhaps of all of them, but you know, 3 ain't great either. So that's, you know, that could happen. The agreement could break down, like nobody could move first. We could get to the prior status quo. I think there's like light and heavy versions of that, like where countries just kind of do their own thing. Like the US did its guilty and its CAMT, and you know, India does a digital levy, and you know, different countries do their own thing, and there may be some trade conflicts that come out of that. I think the USTR views some of this as discriminatory, though it's not clear they really have a firm understanding of the tax issues involved here. But you know, that's a more unilateral approach, and I think a worse one. And then a fourth possibility is that, well, maybe the agreement breaks down in this form, but it's reborn in a slightly different form. You know, like and you know, I think all of us could probably think of some ways to improve it. But, you know, often in academic settings, like, of course, we could think of ways to improve things. The question is, can you think of ways to improve things that will bring 135 countries to the table and get the thing done? Like maybe, but like the fact that we got pretty close, really pretty close, makes me think that 1 is really the thing to root for here, because I'm not sure that item 4 will live up to our dreams. Like we can all imagine a better item 4, but reality is sometimes a harsh thing. Okay, final slide. What are the lessons for multilateralism? I think we've got a lot of really pressing multilateral problems, not to get too big picture on you, but climate change certainly comes to mind, right? So if we thought about like, how could we apply these lessons to climate change, right? You've got a lot of the same ingredients. You've got a prisoner's dilemma where each country would want to do something different in isolation than if they could cooperate, right? We've got a desire for real policy change, at least spoken, not always acted on. Like countries vary in terms of how ambitious they are in this regard. And the United States has done very little, aside from now the green energy tax credits, which I'm very happy got done. But you know, that's a tension there between what's good for one country and what's good in general. You need a response to free riders. We don't really have that, right? Like, so there's the UTPR in the international tax context. There is potentially some things that could play that role in the environmental context, like a carbon border adjustment, where you could imagine the EU is contemplating saying, okay, well, we've got a price on energy. If you want to, you know, send us steel, you too should have to, at the border, adjust the steel price for the fact that you didn't put a price on energy, and steel is very energy intensive, right? So that could be an incentive for countries that are very reliant on trade, particularly trade in dirty products, to adopt their own carbon pricing initiatives. And that would be nice. Another possibility is just like a climate club. William Nordhaus has talked about this, where like countries that are ambitious make a club and then have more uniform tariffs on other countries. And I'm not like a tariff person, you know, I kind of like trade, but one of the things that we're missing in climate change is this response to free riders, right? And of course, leadership moments are important too. So I guess that's where I think that's my last slide. Yes. So that's where I will leave it, and I welcome your questions or thoughts. Yeah.
You actually contact me in headquarters and source case. And I actually personally am all over all of actually really changed like very like expectations, but very profoundly.
Yeah.
the incentives in those.
Yeah.
And I was wondering, first of all, because it changes so much based on the rescue and revenues.
Yes.
From the confusion where they got a lot to basically.
Yes.
And so I was wondering if this might be why the US don't much implemented right now, and also if this hampers basically the pull up which you are to actually get everyone this mistake. Well, Germany energy plan going on, they implement you, and then they first give all benefits which you are, but then the source countries say, well, it's much easier if we implement the here to here. Yeah. Get all the benefits, then this is my properties that's smart to implement it for even G5.
Yeah, so I think the agreements, including the QDMTT, which now I noticed they're now just calling QDMTT, in one of the recent documents, the fund intriguing. I think that is a helpful factor to the extent that what's going to happen is a lot of revenue will then be QDMT, right? Countries will have a strong incentive to put in a QDMT. As we point out, that gets rid of the GDPR revenue, gets rid of the IIR revenue. But imagine a world where every country has a QDMT, very later QDMT, qualified minimum domestic top-up tax. Right, at that point, you really are doing what the agreement intended, right? You're raising the bottom from 0% to 15%, right? And that is still an extremely useful thing, right? And it's a reallocation to the source, as you point out, which is after all the source. Like if we're concerned about the misalignment between real activity and profits, right, we kind of want companies to put their plant and equipment and employment in the places where it's best for them to put their plant and equipment and employment, right? And then those governments can have 15% without any fear of corporate tax base erosion. And so I think from the perspective of a developing country, this is a very important thing to be able to do, right? Because if you're at 15% now, right, like why would people want to necessarily keep the money there when they can find a more favorable place, right? How does this help the big countries? It helps the big countries in part by lowering the differential between their rate and the lowest it could possibly be, right? So imagine that you wanted to do a 21% country by country in the United States, which frankly I want to do, I'll admit it. I think the United States can get away with having a 6% higher rate than other countries, and get a lot of revenue from that, right? But it's much easier to do 21 when everyone's doing 15 than to do 21 when there's a bunch of options at 0, right? So the revenue comes not so much from the instruments themselves, the IIR, the UTPR, it comes from the realignment of profit with activity that can happen and the reduction to the profit shifting motive, right? So it might not actually get booked. Like if you look at the table afterwards, you might be like, well, this isn't doing that much, but you'd see it in the corporate tax base, right? Because the corporate tax base would start to look more like what it should look like, so I think it's okay. Yeah. Yeah.
One possible future you didn't mention is the idea of a UN tax convention.
Mm-hmm.
And so this is something that's been pushed by tax justice networks as well as some others, and it seems to have gained some political momentum in the last few months, including the UN Secretary General. Do you see this as at all plausible in terms of the process that moves forward? Two, if it does, produce any kind of outcome that we see real. And then 3, if it does gain political momentum, might it have an impact on countries that really want to see the OECD deal go forward and compel them to?
Yeah, those are really, really good questions. I would be hopeful that the third mechanism would hold, that people would say like, well, we got to this, let's move forward and do this. Because I think, there's a little bit of a tension. When I was just teaching this agreement in class and I compared on the slide, the OECD and the G20. And I was like, so the OECD is a bunch of rich countries. They add up to this many people and they have the average GDP per capita of this. And the G20 is 2/3 of the world and much lower. And it just looks so much more like plausible as a group of countries that really represent the world. And obviously the UN has that to its credit as well. Like we might think the OECD is like a bunch of rich countries, which it is. And that their interests are different, right? So I'm sympathetic to this motive. I do think there's a little bit of a tension because of both tax expertise and like the real status of world power. And, the OECD has an enormous amount of expertise, a lot of data, a lot of close relationships with the relevant actors. They might be more able to get this done than something that might be more idealistic and in a way appealing, but less able to do the sort of realpolitik of getting it across the line. So I think that tension is definitely there. I do think the OECD has made important steps in being more inclusive, like the very fact that it's called the OECD G20 Inclusive Framework. Everybody calls it the OECD thing because it's too long to say OECD G20 Inclusive Framework. But it really is truly more inclusive than things had been in the past. And it shows like the G20 is very much involved, right? That it's true the inclusive framework includes a lot of things that a lot of countries that may not have their voices heard as clearly as the typical OECD member, but at least, they're part of it. I mean, it's a little better than it was in the past. So I guess, I really do like idealistic things, but I also think, sometimes just incremental progress is the best we can hope for. And I do think we're achieving some incremental progress at least. But that's a very good question. And I realize I didn't quite answer it, but very good one. Yes. Sorry, behind you maybe first, because we haven't heard from her, and then we can come to you. Yeah.
That's a very good question.
Yeah.
So we're talking about a scenario where that project country is reflected in the past, where those countries, but let's say if these countries having no tax, would you see the US still being able to collect revenues through the CFC rules?
If the host country, does what, will the US be able to?
If we're in a scenario where the host countries are collecting in no tax, the US would do a lot of revenues. Yes. But they could still collect some tax through the CFC rules, right? Like they could maybe have the currency. Yes. The host countries. Do you see that?
Yeah, I mean, I think CFC rules are definitely a place to collect revenue, and the US still would. But I do think adoption by other countries will have a very real incentive, not just in terms of revenue, but in terms of simplification, right? I mean, I think you have to sort of imagine the life of a multinational company in the event countries adopt and move forward on this, and a US multinational companies in the United States, they will have a GILTI regime, right? They will have a CAMT regime, and they will have this bewildering set of things happening nationally, right? And that's gonna be a lot, right? So I think that is not a stable equilibrium, and so I wouldn't maybe analyze it with the respect of that being what will stay. So I think something else will happen, and that will shape the pattern. But that's just what do I know? Again, I don't attempt to prognosticate here. It strikes me that would be pretty unsatisfying.
We have time for more questions.
Yeah.
Thanks for the presentation. I'm curious to know what you think about something that I experience very often when I'm going to present this case, not this, but I interaction with the development and seeing their reaction, right? So what I've seen is that they are not very sensitive to the argument that Pillar 2 overall is going to affect profit shifting, which is affecting them more than developed countries. So they don't see the revenue gains from the profit shifting side, and they see little revenue gains from the TR side, from tax incentives, because they feel they are already positioned or above the 50% generally. And on the other side, they feel like they are missing something in terms of investment, which is empirically and theoretically questionable, but this is how they see it. So one of the questions that really challenged me when I was presenting something, there was someone from the official from the government saying, hey, but if we can't use taxonomy anymore, what can we use? And because we don't have much more for them now. But I would be curious to know when you will answer to this question.
Yes, yeah, I do.
And
Yeah.
whether we think, because I think so, that this is all good, but we really need to think about how to support developing countries in the transitioning period. Because it's true that many developing countries right now, maybe for the wrong reasons, rely on these instruments.
Yeah, I guess I would point out that if you are limited in your ability to undercut each other, that can be a good thing, right? So imagine a company that's trying to decide between three poor countries, right? And they're all like, here, have this investment, here, have this investment, or this investment inducement, and they hand out things. It's like when Amazon wanted its second headquarters and every city is like throwing money at Amazon to try to get the second headquarters in their city. Like if they could have all agreed, none of us will throw money at Amazon, right? Perhaps Amazon would have ended up in the same place, but everybody would have had a little more revenue. So I'm not completely convinced that the ability to provide these incentives is doing as much work as they think relative to an environment where everyone has agreed not to do the incentives, right? Because if everyone agrees not to do the incentives, then, countries can compete in other ways, right? And their revenue base all the way up to 15%, right? They have zero concerns about shifting out. And when the IMF, there's a Crivelli and his co-authors, or I think it's a him, Crivelli and co-authors have shown that like the profit shifting loss for poorer countries as a share of their GDP is much larger than for rich countries, right? So if you can reduce that incentive, which I know might be hard for them to see, right? But 0 is really quite a bit lower than 15, right? So it makes it easier to be at 18 or something and collect all 18%, right? Than not, right? So I think I'm all for more things to support poorer countries, but I'm not sure unbridled tax competition is really in their interest or in the interest of the world.
All right, perhaps this is a good time to thank him. Thank you very much. Thanks.
Good afternoon, everybody. So I have the challenge to keep you awake and digesting time. I hope I will be up to the task. My name is Bruno Casella. I'm working at the United Nations. I'm working in UNCTAD, which is an agency in the Secretariat of the United Nations. And I'm going to present a work on the impact of the global minimum tax on FDI. As I was saying before, I'm not a tax person. I'm an FDI guy. I don't know if this is good or bad. The good thing about it is that sometimes people don't know what I am. But I mean, generally speaking, I deal with international investment of multinational enterprises, especially in developing countries. So we will see that perspective here. And this work is part of a broader study that we did in the World Investment Report, which is our annual report. And it's probably the most relevant report on FDI that is published every year. And this year specifically was about the impact of the global minimum tax on FDI. The part that I'm presenting today is the most analytical part. So it was also published in a paper that I co-authored with Baptiste Souillard, a very brilliant young researcher that was recently awarded also by the EU Tax Observatory. And it was published in the Transnational Corporation Journal, which is our academic journal. So let me just take 2 or 3 minutes to explain why I think it's very important to look also at the investment side of the reform, and especially of the global minimum tax. There is a lot of discussion about the revenue impact of the global minimum tax, of the BEPS reform, and a lot of debate about that. But investment is the other side of the coin in some sense, because the global minimum tax actually applies to international investment. And unfortunately, that's our weakness as the investment community. We haven't had the same level of debate and conversation around the implication on investment on the global minimum tax. And I would say that the World Investment Report, and this study is the first study that comprehensively tried to address the implication of the global minimum tax on FDI. And with this study, we really hope to start stimulating a discussion around the investment implication of the reform, of the BEPS reform. On the other side, as I was mentioning before, when we go to developing countries and we present this, we realize 2 things that are very important. The first thing is that investment policymakers have a very low knowledge of what is going on and what is expecting them. There is a very low level of awareness. There is a very limited exchange of information, I would say, within national government between the finance and the investment/industrial departments. There is no cross-fertilization between the two. I would say that there is almost no leakage of information. So we find a very, very limited level of awareness. So that's one thing. The second thing, we have even a more evident proof of how tax incentives, which are going to be very much affected by this reform, are relevant for developing countries from their perspective. So we have always known that tax incentives are a tool for developing countries, right or wrong, but are a tool for developing countries to attract investment. While presenting this to developing countries, I had a sort of doubt that it's not one tool, but it's the main tool. I mean, this is the way they perceive it. So low level of awareness, very high relevance for them. So that is for us the basis to start this discussion around the implication of the global minimum tax on investment, particularly from the perspective of developing countries. So I will present today the more analytical component of our study. And the good thing about this is that it's all based on country by country reporting. So it fits very nicely with the topic of this conference. So the first question we asked them, maybe very obvious question, is, okay, if we want to know what could be the implication of the global minimum tax on international investment, the first question we should try to answer is how much more multinational enterprises are going to pay on their foreign income because of the global minimum tax. And how the tax rate differentials, the ranking between the tax rates, the effective tax rates applied by different host countries change because of the minimum tax. The impact on the level of the effective tax rate and on tax rate differentials are factors that can affect both the level and the location of the investment. So trying to answer this question, we looked first at CbCR. So this is what we found. Just by looking at the effective tax rate that's resulting from CbCR reported by different host countries, in particular developing countries. I would start with the bubble at the bottom. So we find that the share of developing countries which have an average effective tax rate as reported by CbCR below 15% is 30%. So 30% of the countries that have, they report an average effective tax rate below 15%. 70% are above the 15% threshold. So we from this perspective, we could say that those objections for which perhaps for developing countries 15% is too low are well motivated. I mean, most of developing countries, they already have an average effective tax rate that is above 50%. So in theory, they would not be affected by the global minimum. This evidence is even more striking when we weight these countries by FDI, which is the object to which effective tax rate applies. So which gives us the mass and the tax and the idea of the tax base. When we weight these countries with FDI, we realize that around 5% of FDI would be exposed. So they pay an effective tax rate below 50%, so would be exposed to the consequence, to the impact, the implication of the global minimum tax. Then the simple average across developing countries, as reported by CbCR, is 20%, and when it's weighted by FDI is 23%. So from here also we understand that it's mostly smaller countries in terms of FDI, of inward FDI, that have lower effective tax rates. But the picture that we saw before, in reality, and this is probably the main innovation of our approach, is a naive picture, because it's not really the effective tax rate reported by foreign affiliates, or it's not only the effective tax rate reported by foreign affiliates in the host countries that matter, because we know there is a part of the income that is generated by the foreign investment that is shifted away. So the host countries ETR capture the effective tax rate applied only on that part of the foreign income which is reported in the country. We know that around 30–40%, estimates are different, of the income generated in host country is shifted away. So a more comprehensive metrics of effective tax rate should be a metrics that take into account these two components. And we came up with a new notion of ETR that we call the FDI level ETR, to show that is really that is really targeting the whole foreign investment, not just the part that is reported by the foreign affiliates in the host countries, including the income that is shifted away. And clearly, the FDI level ETR is then calculated as a weighted average by the ETR that is reported in the host countries and by the ETR that is applied in the tax havens. Weighted by what? Weighted by the share of profits that are shifted by the various host countries in the tax havens. And we have now very powerful methodology to track this. In this case, we have used the profit misalignment approach. So again, we are in the CbCR setting, but we have also compared with other approaches like the method of Tozlov and Zuckman, and the results were consistent. So what we did is, for each host countries, we reconstructed at the bilateral level the share of foreign profits that were shifted in the various tax havens, and we have calculated an FDI level ETR as the weighted average of the ETR applied to the reported by the host countries and the ETR reported by the various tax havens. Of course, the FDI level ETR is smaller than the standard ETR, than the host countries ETR, because the effective tax rate applied in the tax havens is smaller than the effective tax rate applied, is way smaller than the effective tax rate applied in the host countries. So here we see the difference. Let's look at just at the first line, the word. So the green bar is the FDI level ETR. So we have calculated on average is 15%. If we look just at host countries ETR, so if we average the host countries ETRs across all countries in the world, we would have an effective tax rate of 17.5% or something like that, which is what I indicated with a gray component. So in other words, once we factor in profit shifting in the calculation of the effective tax rate, so we turn from standard ETR to FDI level ETR, the global average decreases from around 17.5% to 15%. So there is a decrease of around 15%. So this 15% can also be interpreted as the saving that multinational enterprises do because of the fact that they shift profits. So here we have three measures of ETR that we usually play with. One is the statutory corporate tax rate, which at the global level is around 27%. Then there is the host countries ETR that from CbCR is around 17.5%. The delta between these two is mainly tax incentives that are provided to multinational enterprises to attract investment. And then there is another delta, which is from 17.5% to 15%, so from standard ETR to FDI level ETR, which is around 15% delta, which is the effect of the fact that multinational enterprises shift profits to low tax jurisdictions. Now, one good thing about this is that with this technology, it was once we did this big empirical exercise to reconstruct bilateral profit shifting at the granular level for many host countries, to which I have to give credit to Baptist. So when we had this technology in place, it was pretty straightforward to calculate the impact of the global minimum tax, including the effect of the minimum tax on profit shifting. And this is what I want to show you here. So I didn't want to show you formulas, but I mean, let's imagine this weighted average. So on one side, we have effective tax rate reported by the host country on the income that is reported in their host country with a certain weight. Say, in France, 70% of profits generated by foreign affiliates in France remain in France, are reported in France, and on these profits, we apply an effective tax rate, which is the French effective tax rate. 30% of the profits are shifted away. They are shifted to tax havens, to Netherlands, to Luxembourg, to whatever. And they are taxed at a lower effective tax rate, say 0.5%. Okay, this is the starting point. Then the global minimum kicks in. What does the global minimum to this weighted average? It does three things. First, if the effective tax rate in the host country is below 15%, it goes up to 15%. This is something that we have called the ETR effect. It's the classic effect that we all have in mind. Second, the effective tax rate in the tax havens go from around 0.5% to 15%. That's for sure. That's a big effect. So they pay more on the profit that they shift. Third, the weights between profits that are reported in those countries and profits that are shifted change. We expect companies to shift less profits. Okay, so we were able to size these three effects, and at the end we calculated the impact of the global minimum tax on FDI LTR. So the impact is around 15%. So the global minimum tax is going to increase FDI level ETR on average at about 15%. We have also a more aggressive estimation that places the impact around 20%. So in other words, multinational enterprises are expected to pay between 15 and 20% more in terms of taxation of their foreign income because of the global of the global minimum tax. Okay, this one I skip. Here we see how we can decompose the effect of the global minimum tax on FDI level ETR in the profit shifting part and the ETR part. So the green part is the profit shifting channel, and the orange part is the ETR channel. So the green part is the impact that derives from the fact that we shift less, and what we shift is subject to a higher effective tax rate, and the green part and the orange part is basically just the increase in the effective tax rate in the host country. There is a very important finding here, I think, it is about developing economies. It's what I was saying before. Developing economies gain most of the tax revenues by profit shifting rather than by just increasing the tax rate in the host countries. The reason is that the effective tax rate in host countries is already quite high. And here is the final finding I wanted to share with you, and it's about tax rate differential. We would all expect that raising effective tax rate in all host countries to 15% would kill tax rate differential. No, that's something that, anyway, would significantly limit tax rate differential. Now, if we look at tax rate differential from a standard perspective, that's true. They go down by 30%. Countries with effective tax rate below 50% goes to 15%. Countries above remain where they are, so the range is compressed. But if we look at the impact on tax rate differential from the lens of the FDI level ETR, the impact is much smaller. It's 15%, and the reason is that profit shifting acts as a sort of profit shifting by itself, and it's the left side of this chart, already reduces tax rate differentials. So the delta, because of the minimum tax, becomes smaller. So in any case, we see the tax rate differential will decrease by 15 to 30% because of the global minimum tax, and this is a very good news. I can conclude here. I just show this this chart, which contains our policy recommendation. So the main takeaway from this study is that the implication for investment for developing countries may be significant. So what we really propose and recommend in the report is to support in different ways developing countries in this transition. And here there are listed 3 recommendations, but I let you just read them. And I conclude here. Thanks.
Does it matter whether it is book effective tax rates, cash effective tax rates, or your calculation?
I don't know really, but I would say yeah, it can. It's something that we are working on, but I yet don't know.
I have one. You have a high ETR in developing countries potentially because of extractive industry that has sort of double tax, the corporate income tax.
We are trying to understand why it's effective tax rate design in the developing countries. My feeling is that it's different things. One, it's the mining industry. One, it's also the fact that I think the developing countries tend to allocate incentives, to allocate a lot of incentives to a small number of companies. So like big discounts, tax holiday exemption to a small number of companies, while most of them. So I think it's very polarized. So as a result, on average, the effective tax rate is high. It's very difficult to check this because we don't have more granular.
Maybe with the public CbCR, they have because we have.
Yeah.
I mean, we're just oil companies in developing countries that get very high effective tax rate, and that's how they sell. We don't do profit sharing, so the overall effective tax rate is quite high, and it's driven by developing countries.
Sure. Sure. I think it comes a lot from mining. I agree. And it would be good to understand why. One thing that maybe I can show you just this. One thing that is related to your question that I think it's very important is that when we look at the impact of the minimum tax on FDI level ETR in the countries, what we do, because of the limited data that we have, we look at the average effective tax rate. But average effective tax rate, of course, hides the heterogeneity behind. And depending on the distribution, which is what you were talking about, of effective tax rate within countries, the impact on FDI level ETR changes completely. So here in the green bar, there is our estimation of the impact. So FDI level ETR would go up 3 percentage point as a result of the minimum. But if you just assume that the average is the result of distribution with a weight in 0 and a weight in the statutory tax rate, the impact of the minimum would go to 6, so would be doubled. So being able to model the heterogeneity inside countries becomes critical to have a solid estimation of the impact of the minimum tax. And this is, I think, a very important next step. that we would like to work on.
Thank you. Thanks.
This one.
I'm very happy to present my paper entitled Tax Planning by European Banks. This project was ongoing since a while when I was in my PhD, and I'm glad to get back to it now. So also I'm a postdoc at the EU Tax Observatory, because I skipped introducing myself. And so as you all know by now, because it's the end of the conference, in 2013, there was a European directive, CRD4, that required banks to publish on a country-by-country reporting some of their information. So this was a very interesting time because it enabled many researchers to construct a database that comprises these information. And why is it important? Because first we can get a notion of the activities of multinationals, and here in this case of banks in the world, and non-havens and tax havens. We can also try to have a sense of whether there is profit shifting, and also this data could be used for other policy instruments, like the minimum tax rate, the global minimum tax. So a little bit on this data, for the bank CbCR, they only report the turnover, the profits before tax, the number of employees and the taxes paid, and whether they receive public subsidies. So unfortunately, not all of them report the assets by country, which is of course a major drawback with respect to the new CbCR now. They are required to disclose the assets, which is good. And also we don't have a differentiation between the unrelated party revenues, etc. So it was a bit limited. The sample that I constructed has a period between 2014 and 2020. So this is, I would say, the longest sample within CbCR until now. And so I have 51 European banks, 37 of them are systemic, and the others that I collect are non-systemic, so probably smaller ones. And they are headquartered in 17 different EU countries, and some of them operate in up to 79 countries in the world. And I also, so I'm not going to present it in this paper, but I also started collecting data on foreign banks that are operating in the EU, because they also have the requirement to disclose their country-by-country reports. And this has not, I mean, as far as I know, it has not yet been like nobody, I think, worked on yet, maybe. And it would be also interesting to see what foreign banks are doing within the EU. Unfortunately, so for these foreign banks, we can only observe their country-by-country reporting inside of the EU. So you cannot really see what they're doing in other countries. But still interesting. So this is a snapshot of the banks that I have. So if you're interested, I published these data publicly. You can find it on the website of the EU Tax Observatory if you want to have a look. So far, I only published, I think, for 36 banks, which are the systemic banks. So they are the largest banks in the EU. And for the smaller ones, I will publish them soon as well. So you have, for the banks, you have from Austria, Belgium, Bulgaria, Cyprus, so for many different EU countries. And the foreign banks that I have so far are US,
based banks, and the Swiss and one Chinese bank. So just to get a sense of this database, the top 10 countries with profits before tax are, the first one is Hong Kong, and this is driven by the huge activity of HSBC in this country. Then we have US, Mexico, Brazil. So interestingly, the four first countries are not European. And then we get to the UK, Germany, Luxembourg, Czech Republic, Italy, and Belgium. So it is also interesting to see how these profits differs within the country type. So I'm checking here the profits, how they differ within non-havens, the domestic market, the headquarter, and tax havens. So we can see that there's like a stable trend. I would have expected when collecting the data that maybe after the reform, the share of profits booked in tax havens would decrease, but it is kind of stable, and it accounts for approximately 16% of the profits are booked in tax havens. Then I look at the ETRs. So of course, in tax havens, we expect that it's going to be lower since by construction, they have a low statutory tax rate. I mean, not all of them, but some of them, they have a low statutory tax rate. And so for these countries, we have an ETR of around 12 to 13%. And for the others, it's for the domestic countries, 19%. And for the non-havens, it's around 23%. So of course, you're going to say that in tax havens, you would have maybe expected that I'm going to say it's like an ETR of 5% or 6%. So it's not really a low ETR, but I think it's because the definition of tax haven itself comprises very different countries. And that is, of course, within this group of tax havens, we have some that have very low ETRs and some that have not so low ETRs. But also an interesting thing when looking at the trends of the ETRs is that we can see that there is not a lot of difference and that the ETRs in the domestic market are 19%, which is kind of low. And this maybe, stresses the idea that there was maybe a race to the bottom in tax rates, because we can see that it's 23 and 19%. So it's a little bit far from the statutory tax rates that are fixed by countries. Then we move to a very interesting indicator, which is the profit per employee or the productivity of employees. And here we can see that really there's a huge difference between tax havens and the other two types of countries, which are the domestic market and non-havens. So this could be explained, of course, by several notions. Either banks are engaging in profit shifting, or maybe also in tax havens, because some of them are financial hubs. So the profitability there is super high. So there can be many factors here. So what I do next in this paper, so I try to check to estimate the semi-tax elasticities and see how if profits are sensitive to the level of taxation. And then I try to have a sense of profit shifting. And then at the end, I'm going to present as well the potential revenues from minimum tax from this sample of banks. So here I consider the systemic banks that I talked about, 37, and the smaller European banks, but I don't consider in this analysis the foreign banks in the EU. And I follow the strategy, the model constructed by Hines and Rice that you all know, and it consists of regressing so I take the log of profits before tax, and I regress it on I take several measures of indicators for the tax variable and firm and country characteristics, of course, time, country, and bank fixed effects. For the log of profits, so here I had to restrict the sample to the positive observations. But for the 0 ones, what I do to overcome this issue, so I just add 1 to try to solve it. So it's a simple way, but it avoids me to losing some observations. And the results, so for the, just to talk a bit maybe about the tax indicator. So I take 4 different specifications, one with the effective tax rate that I compute from the database, but of course it's like an average, so I don't end up with indigeneity problems. Then I also consider the statutory tax rate and 2 other measures that I construct, which are the difference between the ETR in country I, let's say, and the average, the weighted average within all the affiliates. And I do the same with the statutory tax rate, this tax difference. With all the specifications, we have a negative relation. And with the statutory tax rate, it's not significant, but it's still negative. And this can suggest that maybe the statutory tax rate are a little bit disconnected from the reality of if we compare it with the ETRs. And then what I do next is that I take the subsample, so I divide the sample within tax havens and non-havens, and it's very interesting to see that in tax havens the semi-tax the profits are much more sensitive to the level of taxation, because we end up with the semi-tax elasticity of minus 1.7, whereas in the for the other sample it's minus 0.5. Then I try to investigate whether whether having a lot of intangibles affects this tax sensitivity. So I compute the ratio of intangible assets divided by the total assets for each bank, and I take the four quartiles, and so here there's no like strong evidence that the banks that have more intangibles have profits that are more sensitive to the tax rate, but at the same time the semi-tax elasticity is the larger, and it's also significant, but it's very close to the other ones. So minus 1.0 something, and then you have minus 0.9, and with the first quartile, it's minus 0.8. So it's not a very strong evidence. And then I try to investigate the same, but for the firm size, to see if the bank is, if we have like a larger bank, if the semi-tax elasticity occurs. And so it is only significant within the fourth quartile. So with the largest banks, it's minus 0.7. But at the same time, if we look at the first quartile, it's minus 1.1. It's not significant, but it's still a little bit interesting to see that it's not a small coefficient. Then I try to investigate the profit shifting measure. So based on the semi-tax elasticities that I showed you in the first table in the baseline specification, I take the one that is minus 0.8 for non-havens, and I take a different one for tax havens, since they are more the profits respond differently to the level of taxation, and I calculate the true profits based on this semi-tax elasticity. Then I infer the profit shifting from it, and I reallocate the profits with respect to the real economic indicator that I have in my database, which is only the number of employees, fortunately. And so the fun thing is that the profit shifting, like the amount of profit shifting that I end up having, is only 4.6 billion for these 50 banks, and the share is only 5%. So it's like saying only 5% of the profits of banks are shifted. So why? I mean, I think one of the reasons why I have such a smaller estimate with respect to the literature is that the semi-elasticities that I find are way smaller. So it's minus 0.8. It is still in line with the literature because in many studies, they say that, okay, the average semi-elasticity is minus 0.8 between this and minus 1. But the studies that usually have larger estimates have use semi-tax elasticities of minus 2, minus 4, and even minus 5. So it's very different from the minus 0.8, but it's still a number to reflect on. But also something interesting to say for the EU. So profit shifting is here. I present the number, but if we cross the outward profit shifting with the inward profit shifting in the EU, it almost collapsed to zero, and this is maybe due to the activities of the European tax havens. So the EU at the end of the day is not maybe losing as much, at least from the bank sample that we have. Then I use these data to try to have a sense of what could be the potential revenues from a global minimum tax from the banking sector. And I do it with two different scenarios. The first scenario is when the headquarter country is the country that is going to collect the top-up tax. And in this case, it's a European countries, the headquarter countries of the 36 banks that I have. For the QD entity, which is the host, when the host country is going to keep the top-up tax for itself, we have different countries that are going to collect this top-up tax. So the revenues, these are the revenues for the EU plus the UK. And we can see that over time, so of course it's not implemented, but it's like a scenario where I say if it was implemented since 2014 with the data that I have, how much we would obtain as a minimum tax. And here I don't take into consideration the carve-outs. So these numbers are without the carve-outs. And we obtain with the headquarters scenario a number that is around 1.3, depending on the year, billion euros. With the QD entity, it decreases because the money will outflow to other countries outside of the EU. One thing that I forgot to mention here very quickly is that the tax losses from the 4.6 billion of profit shifting that I find is around 1 billion. So actually with the minimum tax, it would compensate if there was profit shifting, this would compensate for the revenue losses. And then this is just a table that shows how between the headquarters scenario and the host country scenario, how within the EU plus the UK, how the revenues would be different. So for example, if we take Germany, you would see that in the headquarters scenario, it collects revenues, but in the host country, it won't. And this is just a table from another paper that we have, if you're interested about the minimum tax, with my co-author Teresa and Gabriel. We did some extensive work about the minimum tax, and I arrived to the conclusion. Do I have time for the conclusion or no? Yes. So to conclude, using the country-by-country data, I estimate the semi-tax elasticity to be around minus 0.8, which is a lower estimate to the other studies. The tax differences among countries have an effect on the profit allocation, and banks reduce their tax burden by operating abroad. The profit shifting that I compute is around, so this is wrong, this is not 2 billion, it's almost 5 billion or 5% of the total foreign profits of banks, which is also a low estimate. The tax losses are around 1 billion. And what else? The interesting thing was that the profitability ratios could suggest that there's some abnormal activities in tax havens. And I would say that we need more transparency regarding this CbCR, because so far at least for the banks, they were not like reported in an ideal way, since we don't have many variables that we can really say if this is profit shifting or not. So it's still hard to distinguish the effect. And the minimum tax, I mean, at least from what we saw, might discourage the banks to use the low tax countries and the tax havens specifically. And it would generate an amount that could compensate for profit shifting. Thank you.
Question? Yeah, I have a question about your shifting model that you got from Heinz and Price. Are you concerned at all about the production function of a financial institution being different than a non-financial institution?
Yes, of course. I mean, banks in design, they are very different. And I tried to implement several methodologies before choosing this one. So, for example, there's the methodology that was followed by Zuckman, Torstov, and Veer, where they take the different profitability ratios and they compare them within the countries. But the problem is that with this database, I don't really have, so their database was macro, so they could really observe in each country what are the profitability ratios. And with these micro data, it's a little bit hard because I don't have full coverage of all countries where banks operate. So I don't have something to compare with. And that's why I had to choose this methodology. So it's not really ideal, but I guess it's still interesting to see these semi-tax elasticities and how, I mean, I would say it's still like an indicator. It's not ideal, but.
So I just bring it up because there's an accounting paper that's kind of similar. And one of your inputs in the production function is customer deposits. And I don't know how that shows up in your data.
Yeah. So the issue is that, are they working on a country by country level? Because to have deposits for each bank, so the data that I have, let's imagine we have a French bank. And then this bank, the data that I have how much it has activities in the UK, in Germany, etc. But it would be almost, I mean, unless there's some data that I'm not aware of, it would be very hard to know for each of these how much deposits they have. I don't even have the assets, which is a major drawback. So having the deposits would be really amazing. And I'm still looking, for variables that I can integrate to this work to make it.
It would be in case it would be helpful.
Yes, thank you so much. Would be great.
It was kind of related, actually. I was just thinking about this elasticity being very low, while the graph you showed on profitability of the type, like money ratio against employees. And I thought this static measure usually shows much larger estimates of tax or profit shifting. So I was just wondering if you did, if you can compare against that, for instance, the profitability per employee, and see if that is close to other estimates.
You mean to try to do it with the profitability method? And yeah.
Yes, you don't have assets, but do have employees, so it seems like that would be a possible.
Yes, I did this in the version of my PhD. So I did the two methodologies, and with the profit shifting, I mean, the reason why I didn't end up choosing this methodology is again because I really don't have a lot of coverage for these profit before the ratios. But when I do it, I obtain a higher estimate.
Is it comparable to other estimates in the literature, doing the static measure?
You mean what the amount that it's very similar to the literature. And I mean, I think.
And how much is it?
I think it was 16% of profit shifting instead of 5% with the profitability method. But again, it was a bit shaky with this data. Yeah, a higher estimate.
Can you repeat for that question?
I don't know the answer to this or have any inkling, but do you think CFC rules have more of an impact here? Because I was just looking at them across different countries, and it strikes me they would hit banks harder than they would hit traditional activity. And so maybe that's part of the puzzle, is that CFC rules, when they're effective, can reduce this kind of profit shifting because bank real activity looks a little more like passive activity, but I don't know if that's true or something.
Yeah, I didn't think about it, but I will check it. Thank you. I will look into it. Thank you.
Then we have here from Copenhagen with.
Hi, I'm Björn Jørgensen. I'm at Copenhagen. Thank you for inviting me to present here. It turns out that this is joint work with Rodney Brown from UNSW and Kerry Sadiq from Queensland University of Technology. And what we did is we wanted to understand formulary apportionment, how might it work out? And I'm going to describe to you what we did. And then I'm also going to highlight to you what we view as the potential and unavoidable weaknesses. But first, let me just remind you or let you know what is meant by this allocation of taxes. So it turns out currently each country is taxing, but you could imagine a different tax regime where you take the global taxes and then you allocate them out to countries. Sorry, I said it wrong. You take the income before tax and you allocate it out to countries based on some key similar to cost allocation. And basically that is actually already done in practice within certain countries, specifically in Canada, based on corporations that have multiple legal separate entities. There's an allocation across the provinces and territories within Canada. And in Switzerland, across the cantons, there's an allocation similar to what we're going to discuss today. And then in the US, there is 9 of the US states that currently do an allocation of the profit before taxes in order to assign taxes. But there are also other US states, 24 of them, that exclusively use sales for allocation of profits across states and territories. And finally, the remaining of the US states, 37, use a mixed model. And of course, there is room in the formulary appointment for deciding to do the following: to make exceptions for certain industries where those variables you use for allocation do not seem appropriate. Now, what are the 3 variables that are usually used or proposed to be used? It's revenues, it's the number of employees or the cost of the employees, and then it's total assets. So what we're going to do is we're going to have 2 samples. In our first sample, we're going to take those EU banks that disclose country by country reporting. But in addition to providing country by country reporting, they must also give us total assets so that we can calculate the allocation key based on equal weight on these 3 factors that are commonly proposed. And then as a second sample, we're going to take those generally non-banks who disclose equivalent to country by country reporting the information that we need to do this formulary apportionment. Now, I want to remind you what you already know about country by country reporting in the EU, but add the accountant's details if you like. First of all, UK has left the EU, and we are all very sad to see them go. But while they were in the EU doing country by country reporting, the filing date for UK banks was you must file your country by country report by the end of the following year in which your fiscal year end was. Does that make sense? So they had a full year to do country by country reporting, but their annual report, of course, was due earlier. And one thing that you are concerned about as an accountant, what we're concerned about is whether the differential filing time can affect the entity for which you report, or there could be some kind of hindsight bias involved. But in general, what we're concerned about is whether or not the numbers in the annual report for the consolidated financial statement matches up with the tally up of the items in the country by country report numbers that we use. So one thing is also, while the European data from country by country reporting should be a perfect experiment, we have the following concern. We observe some non-compliance, by which we mean some of the fintech companies that get a banking license do not appear to take the time to fill out country by country reporting. Maybe nobody told them they have to do that. Second, some banks like the today Finnish bank Nordea, now headquartered in Helsinki, used to be located in Sweden, but they are now that they're in Helsinki subject to European Central Bank banking supervision, whereas before they were subject to the Swedish banking regulator. And so if enforcement matters, that could affect the quality of those country by country reporting numbers that we use. Further, as you may all know, country by country reporting actually requires you to give the taxes that you either paid or that you had as a tax expense in your income statement. However, there must be a separate disclosure of the subsidies that you received from the government, which in recent years with COVID, we can all imagine could be a substantial portion of what you would consider to be relevant. So think of subsidies as a negative tax. Now, we are particularly this paper concerned about undoing the eliminations that can occur when you take a bottom-up approach to country by country reporting when you're not an EU financial institution. And as we think about those, there are a couple of transactions that we worry about. We worry about intercompany transactions between two legal entities when you do the bottom-up approach, where one subsidiary sells to another subsidiary. We got to cancel that out. We worry about the account receivable, account payable that could be part of that transaction. We have to worry about intercompany loans between two legal entities within the same consolidated structure. And that carries, of course, interest with it that we also have to cancel out. And then we worry about sort of equity stakes and cross holdings because they can lead to double counting. If one subsidiary owns shares in another subsidiary, and that subsidiary directly or indirectly owns shares in this first initial subsidiary, you get double counting. And you don't want that for your assets, for your equity, for your liabilities, or for your revenues and expenses. So the great thing is, what got us kind of started to think about the importance of this sort of cancellation, if you want, or eliminations, is that we saw a couple of Swedish banks that did both country by country reporting for the EU, and then they did country by country reporting consistent with the GRI and the Capital Requirement Directive. So we could see that they had different numbers for each country for a couple of firms. And that got us sort of inspired to think about what is the size of those differences. In addition, some of the European banks actually have a category called other. They don't specify all the countries in their filings, meaning that they interpret the rule to say that there's a de minimis amount before you have to actually disclose how much is being paid in taxes for each country. That is not the case. And some of the firms, also the EU banks, they worry about whether should you give total assets or should you give total tangible assets. These are clearly different things, and we want it to add up no matter what you provide us, right? So our background is that we are concerned about formulary apportionment, and we want to look at the effect that one might find if you applied a reasonable proposal of formulary apportionment that's currently in place. That would be the EU, the BE FIT, or the OECD two-pillar proposals. And so we try to see what would happen if we applied those apportionments that are in play as possible solutions to this issue of global taxation. Now, I have to give you a caveat up front. You know that firms can do earnings management. There are two ways to do earnings management of their consolidated earnings. Either you doctor your numbers by choosing some accrual selectively that switches income over time. But you can also do earnings management to affect your costs spread out across different parts of your consolidated entity. Those are accrual choices. They don't affect your cash flows. But in addition, firms can do real activities earnings management by selectively choosing where to locate their operating activities that may have tax consequences in the current regime. We're all on board with that. So we're going to try to calculate the counterfactual holding fixed the firm year underlying transactions and then come up with what would the taxes have looked at by country if we had had formulary apportionment. But it's not a true counterfactual in the following sense, because if we had really had formulary apportionment, then the accrual and real earnings management that firms would have done would have been different. So you have to take our results with that caveat that we can't really have a crystal ball because we don't know how to guess what firms would have done had they been subject to this regime. But this is, in our opinion, the best we can do. So I'm going to show you the results for both our samples, and then I'm going to show to you, I hope, what you already know, namely that the eliminations are important for the inferences you make. Okay, so let's jump to the format that you're familiar with. You know, when you see country by country reporting, this is for the Dutch bank ABN AMRO, EU country by country reporting. You know that the income tax expense can be an expense or a cash flow, but we make sure that it reconciles, right? And one thing to consider when you think about tax havens is how do you want to treat a change in the taxes that are in a tax haven when a tax haven like the Netherlands have banks that operate for real in that tax haven and has customers in that tax haven, right? So keep in mind that Netherlands is kind of a special case because there it seems like there are legitimately 3 Dutch banks that are not in the Netherlands simply because it's a tax haven, but they started there a long time ago. And so not everything in a tax haven is tax motivated, right? And then here is the BEPS report for another example under the GRI format. This is Vodafone, which gives us, as you can see, the unrelated party and related party breakdown of revenue, adds it up to totals, which is not required by the EU. And it gives us accumulated earnings and stated capital. Some of you saw that in a poster session today. And it gives us the number of employees, as is also required in the EU, right? And then tangible assets other than cash and cash equivalents. Cash and cash equivalents, its own wonderful tour for accountants to think about how to define that, right? But so here we have our basic research design. The first thing we want to do is we want to persuade ourselves that it is the case that the 3 proposed variables that we have in our sample, turnover, the number of employees, and the total assets or the total tangible assets, depending on what we have, that has some kind of association with the profit before tax, PBT. So we just run this regression to make sure that we believe that there's a value driver, there's a reasonableness about what's being proposed within our admittedly non-random subsample. And then what we're going to do once we estimate the counterfactual profits is we're going to apply the proposal, which is to take a third weight, somewhat arbitrary, of each of these 3 measures. And in some cases, the proposals say that you should put 1/6 weight on the number of employees and 1/6 weight on the cost of employees. But again, this is arbitrary, but it gives you sort of the sense that there are things that matter about a physical presence when you think about accounting. Now, here are our 2 samples. In the first sample, again, we took the EU financial institutions that were required to disclose country by country reporting. And then we excluded those in this sample that did not voluntarily also disclose total assets or total intangible assets to us. And in the second sample, we look at firms that are voluntary early adopters or voluntary adopters of the BEPS Action 13 or the GRI 207 and had submitted those publicly. And we find those from public sources like the B team by Branson, supported by Branson, the European Business Tax Forum. So again, we hand collected for a number of countries these. Here's our sample 1, and you can see it's all in the EU. UK is there still. And here's our second sample. It's a hodgepodge of countries, and it is not as comprehensive if you went to the poster session today. But here's what you see. You see that in terms of distribution over time, our earliest year of observations is 2013. We end with 2021. And the voluntary adopters of the GRI is starting in 2015 with a single firm. Our first result is we regress down on our dependent variable, the profit before tax. We regress the three variables: turnover, employee numbers, and total assets. And just referring to the R squares, you will see that we get an R square in our admittedly smallish sample where we have fixed year effect for firm and years, and we cluster the standard errors at around 40%, suggesting that these drivers, any one of them, are pretty good at explaining variation. And when we go to our second sample of those that disclose total revenues, we see much lower R squares, about 3%. And again, in the first sample, it's the revenues that explain the majority of the effect. 5 minutes, perfect, thank you. Now, that's our initial results. Then we take a list of tax haven countries from Scott Durang, and there are multiple lists, but we pick that one and we try to measure how big is the presence of our firms in the first sample or our voluntary disclosure in the second sample in tax havens. And then what we do is we do the formulary apportionment, and we find, without making the eliminations, we find a sort of more complicated picture where the effect of the net reallocation, either to tax havens or non-tax havens, or from tax havens or non-tax havens, is nonsensical. But once we make the adjustments, which take us a couple of slides here, we still, in table 7, we still have not made the adjustments. So it appears as if Cayman Islands is going to benefit, as would Luxembourg, Mauritius, and Netherlands, and the UK, from formulary apportionment. But once we change our data and we adjust for the eliminations, you will see that the highlighted gray countries, many of them will disappear as winners. We also have a losers list on which you find both Australia and Denmark, we are happy to say, right? And they stay there no matter what we do. So in table 10, you see, again, redistributions, but you see that Luxembourg has gone to 0, Cayman Islands has gone to 0, and so has Mauritius, meaning that eliminations are critical to do in order to understand how the reallocation would work based on our approach to the problem, right? So it's incredibly important that you make sure when you use country by country data that it reconciles with consolidated financial statement numbers, because otherwise you might make the incorrect inference that Luxembourg, the Netherlands, Cayman Islands, and Mauritius are better off from country by country reporting, when in fact it is the opposite that is the case. So we see here the reallocation is between tax havens and non-tax havens. Of course, there's also reallocations within the two groups, but the bottom line is that we also did an analysis based on the level of economic development, and we find, as we would expect, that the developed countries are the ones who benefit most from formulary apportionment being implemented, with the caveats that I gave up front, that we don't know how it will change the strategies for earnings manipulation by the firms in any form. So what are the next things we'd like to do? We'd like to do more sensitivity analysis on the type of allocation keys that we employ, like half sales, half employees, or maybe having a 4-factor model, as has also been proposed. And then we want to figure out if we can expand the sample, which we do after today. Thank you very much for your time.
There was nothing on your side, which were the main challenges between the reconciliation and the accounts. Which were the main challenges in making the reconciliation between country by country reporting and the reconciliation?
Okay, so the main challenge, I think the main challenges for us, there are a couple of them. So one of them is the other category, right? That's disclosed by the EU countries. We can't do anything about that. There's prior work by Akbar, Hope, and Thomas, which shows that firms that engage in that have lower effective tax rates, they define their segment reporting prior to country by country reporting to circle around tax havens and include non-tax havens. So you can't tell how much is in a pure tax haven, because the level of aggregation is such that tax havens are not standalone countries or grouped together in segment reports by US firms, independent of CbCR. In terms of CbCR and our adjustments, there's both the third party versus related revenue feature, and then there's the dividends made by one subsidiary to another subsidiary or to the parent, right? And that can lead to double counting in certain circumstances. And there's also something that can happen with earnings from the loans within the entity, among entities. So you can have one subsidiary extending a loan to another subsidiary or the parent to a subsidiary that creates an interest. That interest may or may not be taxable down in the subsidiary level or tax deductible to the subsidiary who receives it. And that can create something that we can't quite undo. But in our subsample, we can fix all of those things. So we have tossed out firms where we couldn't reconcile.
And how is it decided for banks?
So there are 3 Swedish banks who do both, and they taught us what to do, right? So we picked those up. We looked at those to make sure we knew exactly what to do there. But for the EU country by country reporting, the main issue is the other category. And then there's the potential for omitted banks like the fintech companies that should disclose, but they don't, and they probably don't because their financial securities regulator does not enforce CbCR. Nobody's really enforcing it right now.
And were they most which is provided on next days. Which in your software, I think, different countries with different countries. Is that?
Yes. I'm less worried about that, and here's why. We used to have book tax conformity, meaning that many countries, in particular in Europe, not in the US, had one set of books. What you did for financial accounting would also be done for the tax authorities. That is no longer the case, right? So the tax authorities in each country have the right to do a calculation of taxable income using that country's legal rules for doing so. And then each country also has the right to apply whatever tax rate they feel like and whatever tax deductible items they may feel like including or excluding. But the idea inside this, apportionment is that you can only go up to the cap of whatever is calculated at a global level. So I don't think we need to be in the proposal to be super worried about whether that's IFRS or US GAAP, 2 of the big accounting standards. I agree it makes a difference at the country level, but I think that's a legal issue attached to tax law at the country level, not to the apportionment idea, which could be viewed as an upper cap or a lower bound.
Yeah, thank you, Peter. For our final presentation, we have a very thank you for very good presentation. And from the DRN seat for my presentation or speaking.
Yeah, great, thanks. Yeah, thanks a lot. Last but hopefully not least. So this is joint work with Fotis Stellis and Rachel Speiten, who are both working with me at the JRC. And this is going to be something a little bit different than most of the presentations we have seen because we are not dealing really with CbCR in this model. And second of all, we do not really have any research question in mind we are specifically addressing in this presentation. Rather, I'm going to present a tool or a methodology that we can use to address a whole range of research questions. So what is this about? So we are developing a corporate tax microstimulation model to assess the budgetary and distributional impact of tax reforms Microsimulation models are used quite extensively in the field of tax reform analysis, mostly for households. So microsimulation models for firms are quite rare. There's a few examples, although so this is not the first model, but nonetheless, they are not very often used. And in this model, what we're going to do is we are going to estimate firms' taxable income. And I really like that Bjorn mentioned this in his presentation. There is this issue of book tax conformity. So we're going to look particularly at the tax. We're going to try to estimate the taxable income and the corresponding tax liability. We can do that under baseline and under reform scenarios. I mean, here we're just going to look at the baseline. It's a multi-period model, so we're going to look at 3 years, 2016 to 2018. And for now, it's a static model, meaning that there's no behavioral changes in it. All right, so developing this model, and I didn't mention, but this is a pilot model focusing on Italy. It's not an easy task, and the most challenging the element of it is that we do not have access to tax return data. I mean, potentially we could get access to tax return data for a few selected member states or countries outside of Europe, but this is not something that's universally available, as we all know. So instead, what we're going to do is we are going to use financial accounting data, which are not, so instead of tax return data, which are not publicly available. Now, this creates a challenge, and the challenge is, as I mentioned, the book tax differences. Financial accounting and tax return data are not the same. So what we're going to do is we're going to estimate the taxable income through the extensive modeling of all the different tax rules in the member states, in this case, in Italy. Now, that creates another challenge. And the challenge is that to estimate the effect of these tax rules, we need fairly granular financial accounting data, which we can get for some firms, but not for all of them. So we are going to apply a range of imputation methods to predict the entire distribution of tangible and intangible fixed assets by type, right? So the different types of fixed and sort of tangible and intangible assets would be the land and buildings, equipment, machinery, patents, trademarks, goodwill, name it. Different types of financial revenue, in particular dividend income and interest income. And we're going to do something about past losses. The last challenge that we are facing is that publicly available financial accounting data from Orbis is neither representative nor does it cover the entire business population. Orbis is usually biased towards older, larger, more profitable firms. So we are going to use a mix of entropy balancing and reweighting methods to extrapolate our results to the entire population of corporations. And to foreshadow the results of the model, the main result of the model is that we actually overestimate the tax revenues for Italy by about 20% in the current setup. And this is based on 1,000 simulations of the model. And there's several reasons why we actually overestimate the tax revenues. One of them being that we do not model all the tax deductions, but we focus only on the main ones. And in the reweighting, we cannot control for all the things that we would like to control for. All right, so let's have a closer look. We are going to look at a range of book tax differences slash tax rules. In particular, we're going to look at the temporary differences in the tax depreciation and financial accounting depreciation. We are going to look at the permanent differences in exempt income, that would be dividends. The limitation of interest deductibility, right? We all know that not all interest expense is deductible. We're going to look at the tax loss carry forward, tax consolidation, and because we are talking about Italy, there is an allowance for corporate equity, which is a fictitious or deemed deduction for corporate capital. Okay, so a brief overview of the model. We're going to start with the earnings before interest, tax, depreciation, amortization. So everything that happens before that is not part of the model. We take that as given. And what we're going to do is we're going to deduct from this EBITDA the tax depreciations for tangible and intangible fixed assets. We're going to deduct any local business taxes to the extent that they are deductible for corporate tax. We're going to add financial revenue, but subtract the not taxed dividend income. We're going to subtract financial expenses, add back interest paid, and subtract the part of interest that is actually deductible according to tax rules. We do not do anything particular with the extraordinary profit losses. We assume that they are fully taxable. And then we're going to subtract again from the taxable base loss carry forward, tax consolidation, and any allowance for corporate equity. And what you already see here is that we have two sets of variables. We have variables that follow that come directly from the profit and loss statement. And there would be either financial accounting income or expenses. And we have a range of tax deductions that are either observable directly in the data or that we are going to simulate in the model. As I mentioned, we are going to look at 2016 to 18 sample periods. For each year, we have more than 400,000 corporations. So we cover about half of the population of corporations in Italy. And we're going to exclude certain types of firm, industries, and legal forms, right? So first of all, we're going to focus only on legal forms that are actually subject to corporate income tax. So for example, we're going to exclude partnerships. We exclude financial firms because they tend to follow their own specific accounting and tax rules. And we are going to exclude, in particular, agricultural sector because we do not have any macro statistics on that sector to benchmark. You are all familiar with Orbis, so I don't have to explain this part of the data set. However, when I mentioned that we need a lot of more granular data on the types of assets and types of financial income, for this, we're actually going to look at the national version of Orbis. So not many people know that this exists, but it exists for a number of countries in Europe in particular, and Italy is one of them. So it's a complementary database, which has a structure that's very similar to Orbis. However, it has way more granular data, right? So we can see that different types of fixed assets, we can see the different types of financial revenue. We can see a more detailed breakdown of the shareholder equity. And we are going to merge both databases because they use the same firm ID. So that's not a challenge to have a more firm specific rather than some industry average modeling of the book tax differences. So just to show you why we do that. So the first thing that we learn, and this is just, I will mention the two descriptive statistics here. One thing we do that, so we are really that we need this firm specific data rather than some industry averages, that when we look at the firm distribution of land and buildings, we see that, for example, half and more the firms doesn't have any land and buildings, right? Whereas if we will look at some industry average, all in each firm would get like a small fraction of investment in land and buildings. However, we have this data only for a subsample that we have in the model. So what we are going to do is we're going to obtain this firm-specific structure either from the directly observable cases, and for the incomplete cases, we are going to apply a mix of logic and predictive mean matching methods to impute this for the unobservable cases. We validate these methods extensively. So what I'm showing you here is the kernel distribution of the complete, incomplete, and imputed cases. So we actually take half of the sample, we treat it as incomplete, and then we predict the values for that sample, and then we compare the predicted values with the actually observed ones. So you see that for the whole business economy, the predicted values follow the distribution of the actual observed ones very well. At the industry level, there is a bit more variation unless you see that the actual values, so that's in red, and imputed ones in green, they are fairly close. For a smaller industry like mining, there would be a bit bigger difference between the actual values in red and the imputed ones in green. Altogether, for land and buildings specifically, we correctly impute 75% of firms that have no land and buildings at all, and we impute about 80% of the total stock of land and buildings. Okay, so are we there yet? So why do we do this? We do this because balance sheets show the stock of tangible and intangible fixed assets net of financial accounting depreciation. And what we actually need to derive tax depreciation is the gross capital investment. So I will explain what we do with a very simple example. If we take a firm that incorporates in 2010, and we observe the first 3 years of data, so we have a stock of fixed assets, be it land and buildings, of 1,000, 1,100, and 1,200. And let's assume that it has a 10% straight line depreciation, right? So over 10 years. So we know that if this is the original investment from 2010, it should have a accounting value of 900 in the second year. Now we see that the firm reports 1100, so we assume that it has invested 200, right? So we go basically to the extent that it's possible. We go all the way back in time, and we are going to follow the investment at the firm level from the beginning year by year. From these values, so we derive these annual investment amounts, and this allows us to simply apply the tax depreciations. Here, we just assume that the tax depreciation is 20%, so over 5 years, so it's quicker than the financial accounting depreciation, which would actually lead to a temporary book tax difference of 142. Now, this method works very well if we have the complete time series. Unfortunately, we don't always have the complete time series. So for firms with missing time series, either because they don't have the data or maybe they exist for 100 years, we need to estimate the initial stock of assets. And we are going to do this following a non-parametric bin approach. And we use that to simulate the past performance of firms, specifically the growth of assets over time. And this allows us basically to go back to our methodology here, right? So where this initial value would be the one simulated from this non-parametric approach. And then we again depreciate it year by year and derive the annual investment amounts. And this can be also negative if there is a net sale of assets. Okay, so that covers roughly the temporary differences. So the tax depreciation for intangible fixed assets follows exactly the same methodology. Now, moving to the permanent differences. We all know, and I mean, this has been also the topic of a few other presentations, dividends are a big deal. What is particularly nice about the complementary data set for Italy is that we actually observe the split of financial revenue in dividend income and interest income, however, again, only for a subsample of firms. So what we're going to do is we're going to follow the same idea as before. We're going to predict the share of dividend income in financial revenue for all the firms where this is not observable. And we validate this approach in the same way as before. Now, I will be very quick so that I have some time to show you some more results. Now, once we impute the share of dividend income, it automatically means that we know the share of interest income here because financial revenue is the sum of the two. And knowing the interest income actually allows us to work with the net interest expense and have a better, more accurate prediction of how much interest is actually deductible at the firm level, right? So we know that the net interest expense, so interest paid minus interest income, is deductible only up to 30% of EBITDA. In the case of Italy, also there's no safe harbor, so this applies both to small firms and large firms, whether you have little or no, whether you have little interest expense or a high one. Excess interest expenses can be deducted in future years, right? So there is any part of interest paid that cannot be deducted for tax. And in the subsequent years, you have some capacity left, you can deduct that. And also unused capacity from the current year also carries forward to future years. And we can we take that into account in the model, right? So that's why we have this multi-year dimension. So we can follow the carry forwards of the unused, whether it's an unused interest expense or unused capacity into the future. All right, the final two items, the tax loss carry forward. Again, very similar idea to as before. Most tax systems, they allow past tax losses to offset current and future taxable income. We compute the tax losses for the years in the sample, of course. We do not know what are the tax losses from before. So what we're going to do is we're going to proxy for them with negative retained earnings from the financial statements. Again, this is something that we do not observe for the entire sample, but for a subsample of observations, this is something that we would obtain for the Italian version of Orbis. And for all the other firms, again, we're going to impute this in a two-step approach where first we predict the probability of a firm having negative retained earnings, and in the second step, how much. Now, what makes this tax loss carry forward extra challenging is that it also interacts with tax-based consolidation. right? So we also gonna do that. We're gonna basically trace all worldwide ownership links, and we are going to simulate tax groups within Italy. And here we assume that all firms that can consolidate for tax actually do that. Okay, so the last part of the model, as I mentioned, we're going to reweight to address any structural differences between our sample and the total population of corporations. First, we're going to adjust the population shares and scale to match the size of the population of corporations. And in the second step, we're going to use effort balancing to make sure that our sample is not biased towards larger firms. In particular, we're going to make sure that the average employment at the industry size class level corresponds to the one in the aggregate statistics.
You have 5 minutes.
Yeah, great. Now, for the simulation results, we're making actually one simplification for this presentation. We're going to assume that tax depreciation equals the financial accounting depreciation amortization, and we can do that because for the case of Italy, the two should be equal. The only difference is if a firm has some accelerated tax depreciations or some bonus depreciations for specific assets, but that's something that we could also not model in our methodology. So we simply assume that these two are equal. And it's just a pragmatic choice because we recently changed these prediction, the regression models underlying the prediction methods, and it actually takes several days to rerun the entire model. So we took a shortcut here. Okay, the firm specific ways, as I mentioned, they are derived from exogenous variables, in particular the number of firms, employees. If we had more data, for example, on the aggregate financial accounting profit and losses, we could also include that. And then the model simulates the endogenous tax revenues. And as I've shown you before, the baseline result of the model is for Italy as a whole, we actually overestimate tax revenues by some 20%. You see that, so we run 1,000 simulations, reflecting the fact that predictive mean matching has some uncertainty, right? So we're not going to predict one set of values, but we have a whole range of predictions, which basically means that we're going to run the model several hundred, several thousand of times. And this is the average share of tax revenues. But you also see that across this 1,000 simulations, the results are actually very consistent. At the industry level, there is much more variation, right? So you see that for a big industry like manufacturing, we're actually very close to 100%. For other industries like the energy sector, we overshoot by quite a bit more. There might be also some industry-specific rules that we do not capture in the model. Also, real estate sector has a particular issue of reweighting, and that's why we overshoot by double. We can also benchmark specific tax provisions. So again, on average, this is for 2018, we have 120% of tax revenues. But if we look at the non-deductibility of interest, we are actually very close to 100%. And the allowance for corporate equity, we are at about 60% there. So if we, for example, if we estimated this allowance for corporate equity more accurately, also the tax revenue should be a bit lower. So that's something that we can hopefully fine-tune in the future. To show you some basically the effect of accounting for the book tax differences and reweighting. In our sample, we capture about half, as I mentioned, about half of the population. And if we didn't do anything, that half population of firms would pay about 93% of the tax revenues. But if we were to levy taxes on the financial profit and losses, we would estimate 124%. Right? So there is a big gap between these two numbers that reflect the permanent book tax differences, because again, here we do not model the tax depreciations explicitly. Then the reweighting, we actually overshoot the population a little bit. For some reason in our sample, in certain industry size classes, we observe more firms than in the aggregate statistics. And after reweighting, we actually overshoot by some 20%, like I mentioned, even more so at if we were to use the financial profit and losses. And this reflects the bias towards more profitable firms in the underlying sample. We see very similar results at the industry level for the manufacturing. For the real estate sector, I picked that example because we overshoot by, our estimates are double of what they should be. We actually have only 14% of firms that pay on their own about 35% of tax revenues. And here you clearly see a strong bias towards more profitable firms in the sample, right? So when we reweight, really what we should ideally want to do is include the aggregate profits and losses of the firms in the reweighting. Now, final two slides, last minute. I really wanted to make a link to CbCR since this is CbCR Conference. So we identify CbCR firms entities, right, in our sample simply by matching to the ultimate owners and then checking if the ultimate owner falls under CbCR or not. We have less than 6,000 entities for Italy that are subject to CbCR. I think the CbCR number is closer to 8,000. After reweighting, we overshoot the 8,000 by some 2,000. So this is actually also something that hopefully in the near future we can include in the reweighting to get these shares more accurately. And in our model, the sample before the reweighting would yield about 73% of the tax revenues from CbCR for Italy. After reweighting, we predict about 85%. But again, you see a significant difference if you were to levy taxes on the financial profit and losses. So we also, because we do not account for for banks and insurance firms, here we actually subtract taxes paid by banks from the CbCR total. Here we also exclude Generali as the biggest insurance firm in Italy, and that actually improves our score by some 2 percentage points. So just to mention that Generali matters a lot for the total tax revenues. Okay, so that's about it. Maybe the last thing to mention here is that beyond the model itself, I think what this shows is that the notion that effective tax rates are low does not necessarily reflect profit shifting, but it also reflects to a large extent simply the tax code as it is, in particular the exemption for dividends, losses, and tax consolidation. And that is really something that this model can do, which is provide a structural breakdown of why there is such a big difference between the low ETRs and the statutory tax rates. And with this, I will close. Thanks.
I was wondering, so what's the tax base and the
So it's about 30% of tax revenues in the aggregate, right? So and that is attributable only to profit-making firms, basically, right? Because we assume that loss-making firms, they wouldn't pay any taxes if the financial profit or loss was their taxable income. Yeah.
Differences, which are items that are most important?
Well, we didn't look which item weights the most, but we could easily look that up, of course, across dividends, the loss carry forward, and the tax consolidation, of course. I think from the aggregate statistics, it seems that the tax losses matter the most. Yeah.
You're right on time. Do you want to take on Claudia first?
Yeah.
Thank you.
Yeah.
That project is enormous. All good luck. So I'm just few words of thank you, and we are done. So thank you all for coming and presenting and discussing state-of-the-art research that we can learn a lot from. I understand the conversations are not done and are bound to continue. I'm happy to report that they will continue also in Prague. We might have more events in mind, especially because my colleague Miroslav seems to enjoy and seems to be very good at organizing conferences. So so he has volunteered to organize the IAPF conference in Prague in 2 years. So that's, you know, we can imagine his life between now and September 2024. So, you know, anybody who enjoyed it here can come back latest in 2 years' time. But this conference would not be possible without EU Tax Observatory. So, kind of, you know, as we would not be here. We could, you know, even with Miroslav, we wouldn't do it without EU Tax Observatory, you know, organizationally, financially, etc. So big thank you to EU Tax Observatory, which is not an organization, but it's the people. So I'd like to thank the people going from the top director, Gabriel Zuckman, to people who were most involved in the organization. So Julia, Olivia, Sarah. So thank you. This has been great. And last two thank yous I have here. So to Kim and Kat for amazing keynotes, and to all of you for making the Prague the capital of country by country reporting for at least 2 days. So thank you all.
Just one last point. So I know some of you are leaving later than tonight. So if you'd like, we can meet outside the main conference building door at 6 to grab drinks or anything if you'd like. I also sent this by email. If you have any trouble with anything, there's my number as well in the email. So if you feel like it, please do join. Thank you.
Thank you very much.
Great conversation.